In the room and those of you online. Sounds like we're getting an echo. Those of you who are signed into laptops could please mute your laptops. That seems to have accomplished it. Thank you. Welcome to this informational forum from the Finance, Revenue, and Bonding Committee on pension performance. And we welcome our treasurer, Eric Russell, to the microphone. Welcome back. Nice to see you this morning.
Nice to see you as well. Thank you for having me.
The floor is yours, sir.
All right. Well, really appreciate the opportunity to be here and to talk about the work that we are doing in the treasurer's office. We have a really dedicated team that's been hard at work since coming into the office. It was hard to believe about 15 months ago. And really proud of the work that's behind this update and the opportunity ahead as we continue to do that work. Our mission in the office is very clear, and it is to get the best risk-adjusted returns for our pensioners and retirees, and both current and future pensioners. Want to start by just acknowledging the work of Professor Sonnenfeld and his team from Yale that came out last year, which I think was really important, that it brought a lot of light to the work of the office. I think when you think about the role that the treasurer's office plays in the state, it's not one that always gets the most attention or gets the biggest headlines, but it has a huge impact for our state and municipal employees and teachers and retirees, as well as taxpayers in the state, understanding that our pension funds are performing well, for meeting our commitment, paying into our pension funds, that ultimately is saving taxpayer dollars. I've been really proud to go around the state expressing the importance of the role and the work that we're doing, both to many groups, whether it's workers and pensioners, but also to local businesses and chambers of commerce and Rotary clubs, journalists, as well as really sharing the story on the national level with investors who are investing in Connecticut, purchasing our bonds, really thinking about the long-term future and opportunities there. As some of you know, we hosted many legislators at our office over the course of about a week to talk about this performance. So there are aspects in this presentation. There's some slides that may look familiar to some of you, but this is a deeper dive into the pension funds management team and the work that we're doing, and also has some updated information about performance from the calendar year overall. I think, as across the board, there really is an overall renewed interest in the work that we're doing. And I'm, again, really proud of the accomplishments that we've made, but more so the how we've positioned ourselves for long-term success through the office. Just really briefly, this is an agenda that will just cover some of the topics we'll be discussing today. We'll talk about how the pension fund management division is structured. We'll do a deeper dive into the investment process and the investment advisory council and their really important role in the work that we do. We'll go through a detailed report of performance as well as reforms that have been made in the office. And then I'm happy to take any questions at the end of that process. Just to start, these are a few people that are on the leadership team in our office. Sarah Sanders, who many of you may recognize, particularly anyone who spent time on the bond commission, but she's the deputy treasurer. She was elevated after being the assistant treasurer for debt management for many decades in the office. And she's just played a critical role in the work that we've done across the board, particularly in helping us identify unique funding solutions. One of them being to the baby bonds funding earlier last year. Andrea Comer is my chief of staff. Please feel free to reach out at any point if there's anything that we can be helpful with from the office. Many of you probably know her from her time as deputy commissioner of DCP. And then Ted Wright is the chief investment officer. He has done an incredible job leading the PFM team and really building it out, as that's been a really top priority for us coming into the office. As you'll see under him, just to think about structure a little bit, there are principal investment officers for each asset class, and we'll go into a little bit more in depth on that front, but principal investment officer for private equity and private credit, one for global equities, one for fixed income. So we have 7 principal investment officers across the division that really head up the work in each of those investment classes and then lead the team under them, as we have investment officers, associates, analysts that are all working as we do due diligence and work in the office. One thing that I just want to say on the staff front, because I think this is critically important, I believe that we have the strongest and the most depth in our investment team that we've ever had in the state of Connecticut. And ultimately, that's what this is about, is if our strong team is going to allow us to perform well, if you have the right people in place. And so we've done a lot of work, in part led by your efforts in passing legislation last year to make sure that we could really build out the team, recruit top tier investment talent, and retain them. And just to give you a glance at kind of the experience within the office, between our chief investment officer and our 7 principal investment officers, we have over 150 years of combined investment experience. Many of these folks came from the private sector, from organizations like PIMCO and Barings, United Nations, but are really bringing this experience and work when they could be off doing a lot of other things, probably making a lot more money, but they're really committed to the work of the state and the opportunities to protect pensioners in our state. This is an overview of the pension funds management division. And so you'll often hear us talk about the CRPTF, which is the combined pension plans and trusts. There are a total of 6 pension plans and 12 trusts that we are responsible for overseeing and investing, and approximately 300,000 state and municipal employees and teachers and retirees who are counting on us performing well. Our assets under management at this point are $55 billion, which is the largest our pension fund has ever been. And again, our number one priority is meeting the fiscal obligation to those pensioners. This also shows, I think, the breadth of PFM. We often talk about the state employees retirement fund, or teachers, or municipal employees, but there's a much broader responsibility within PFM. And you'll see item 12 there, which is the most recent trust that was added, which was the baby bonds trust that was funded last year. As I go through this, I just want to put in perspective, and this is really important. We're long-term investors. While we certainly can look at short-term investment results, which some of them we're very proud of, and showing that we are moving in the right direction, our goal is to have sustained returns over market cycles, right? As we're thinking about the long-term future of our pensioners. And so we work very closely with a talented investment team in the office, with state government, with external managers, private consultants, and a really talented investment advisory council that we will talk about in a little bit more depth on the next slide. So the Investment Advisory Council, you'll see the members there listed on the left. Ellen Schuman is the chair, who's been appointed by Governor Lamont. She's been on for several years now and has really done an incredible job leading the IAC and working closely with PFM for many of the significant reforms that we've made over the last several years. Myself and a representative from the Office of Policy and Management are ex officio members. There are then appointments from legislative leadership from both sides of the aisle. And then there are appointments from labor. So there are 2 appointments from state employees and then 3 from the teachers unions. As you see, there are a few openings there. One of the other significant pieces of legislation that was passed last year is really allowing us to tap into top tier investment talent for appointments on the IAC. There used to be some potential conflict issues that excluded a lot of the investment talent we had in the state. To your credit, you changed that last year. And so I've been working closely with the governor, with legislative leadership, and with labor to identify investment talent to continue to constitute the Investment Advisory Council. The role of the IAC is really about high-level investment strategy. And so the name Advisory Council is true in some respects, but there are many responsibilities of the IAC that are not advisory. And so if you think about our investment policy statement first, that is the document that governs everything as far as our investment strategy. Most notably, our asset allocation, which really is the biggest indicator, has the biggest impact on how we are going to perform. And I'll go into depth on that in a little bit. But the IAC is responsible for adopting that investment policy statement. And that's a lot of the guidelines in terms of how we can go about investing. They are also responsible for hiring our high-level investment personnel, including the CIO, deputy, all of our principal investment officers. And they also review all of the investment managers, consultant contracts, things that we bring forward to the IAC for hiring. They also have the ability to really sound the alarm in the event that there are any sort of malfeasance or unauthorized or illegal actions that are taking place. The IAC has a mechanism for sounding the alarm on that. The investment process, and this is really important, I think, to just have an understanding of how robust our process is within the office. I think there are many times where the thought is that I'm sitting behind my desk throwing darts at the board or picking managers out of a hat. And I think this really shows the level of depth that we go through as we are making investment decisions. And so if you start there on the left, our manager selection process, this kind of combines both the public and private side managers that we use. For public managers, for public assets, we actually have an RFP process. And so we have a panel of managers that we are able to use for different investment strategies. On the private side, we are constantly looking at managers and evaluating quality of those managers, but also how they fit into the portfolio and when a potential opportunity may present itself. So our investment team, as I mentioned, analysts, associates, investment officers working under the principal investment officer for each of those asset classes does screening and filtering of managers on a rolling basis. They manager meetings, deep dives into performance, qualitative and quantitative reviews of those managers, constantly looking for where those opportunities may be good for our portfolio. These are, again, really in-depth reviews that at times take place over years, where we may have a manager that we have really high conviction in, but they don't fit into the portfolio at a specific time. And so we're looking at when those opportunities may come up. In addition, there's legal and compliance diligence that happens. And while our investment team are doing these analyses, we also have consultants that we work with in different asset classes that will do their own independent review of those managers and make recommendations to PFM and to the IAC. After the PFM team completes their due diligence, and if, say, they have high conviction in a manager, they would bring that forward to through their principal investment officer. Ted Wright, CIO, and myself are constantly in the loop as to what opportunities we may be looking at. And then after Ted is comfortable with an investment, he brings that recommendation to me. I then go through that due diligence. I meet with that manager, ask any questions that I may have of that manager, and then we make a recommendation to the IAC. The IAC then goes through all of the materials, both the consultant review as well as our due diligence, and has an opportunity at our investment advisory council's meeting to ask any questions as we present on those managers. And then we go around the room, and the IAC members then on the record say whether or not they are supportive of moving forward with that investment, at which point I am able to move forward with making that investment. Following the hiring of a manager, we do constant ongoing due diligence, manager meetings, quarterly updates. We have our outside consultants that monitor those managers as well. We actually rely on those managers and work with them just for information, capital market insights, and again, make sure that they are meeting our expectation from a performance perspective. So that's some kind of high level of some of the process. This slide should look familiar to folks who were able to make the meeting. This is our fiscal year end number. So this is as of June 30th of 2023. Our combined pension fund performed at 8.5%. As you'll see there on the left, Pensions and Investments, which is a publication that looks at and tracks performance from 68 public pension funds across the country, actually acknowledged Connecticut for having the highest outperformance of our benchmark over that fiscal year. We were over 2% over our benchmark, which added $1.1 billion to the pension fund. On the right there, you will see performance on a 1, 3, 5, 7, and 10-year basis. And the color code there is the breakdown for the teachers' retirement system, state employees, and the municipal employees. And again, as we talk about the goal here being long-term pension performance, while we certainly are proud of our 1-year number, and I think it's a sign of the changes that we're making really having an impact. If you look at the 10-year number is more of what our goal is to have that long-term sustained performance. We can jump to the next slide. So this is an updated slide that actually has our calendar year 2023 numbers. And so this is from January 1 to December 31st, where we performed at 12.8% as a pension fund. What that 12.8% represents is it actually has us in the top 27% of public pension funds across the country, and our 10-year number in the top 40% now. Just to give you an understanding of how some of this data is collected. So our general consultant is Makita, and so they work with a outside firm called Investmetrics. And what Investmetrics does is gather information from public pension funds across the country and creates these comparisons. So for our comparison, it is actually, it covers public pension funds above $1 billion. There are about 70 public pension funds that are in that analysis. Obviously, just like, if we think about our combined performance, if you think about some states, they have multiple pension funds that are significantly even larger than ours, that are under completely different governance structures. And so they don't have combined performance. So it's not a state to state comparison, understanding that some states have multiple large pension funds. So I think what this shows, one is how our strong performance and really moving in the right direction from looking at some of the comparisons in the past. But it also, I think, points out a lot of the compression, the fact that we've been able to move up the ranks with our recent strong performance. Once you get out of the kind of really top performers, there's differences in basis points that are dividing a lot of the other large pension funds across the country. And so as we really maximize these opportunities to perform, the goal is to see us continue to move up the charts as far as performance. The other thing that I will note in comparing public pension funds is it's really difficult at times because you're not always comparing apples to apples. What Investmetrics does is they're comparing net returns against net returns. So that's taking out fees and management costs and things like that. Not everyone reports on a net basis. What it doesn't also account for is the fact that, if you look historically, we went about 70 years without properly funding our pensions. And to look at a public pension fund and their investment strategy when they're 30% funded compared to a public pension fund that is 100% funded, it is really hard to look at that as an apples to apples comparison. Many of those public pension funds that really did well over that period of time had 40+% of their portfolios in private assets. We were certainly behind the mark on that. And we are in the process of really making those changes as part of our new asset allocation. So this is just a comparison to show what you'll often hear folks talk about as a 60-40 portfolio and where we fall in that category or compared to a 60-40 portfolio over the long run. I think the important number here is on the 10-year basis, so which has us at 6.5% over that period of time for our CRPTF. And if you look at kind of our state benchmark, we outperform that, and then a global 60-40 portfolio. The reason it's important to think about this, we are global investors. We have a global diversified portfolio. We invest all across the world. And so this is against a 60-40 global portfolio. You'll often hear comparisons about us against the S&P, which is all US. It's a US benchmark, right? Being a global diversified portfolio, like all of these other public pension funds across the country, that's the 60-40 comparison that we're really looking at. So just to cover some of the recent changes, and again, many of these being to the credit of you folks here in the room and the legislature more broadly, our big reforms here have been asset allocation, which is it's the biggest driver of our risk adjusted performance as a portfolio. IAC membership, our recruitment and retention of talent within the office, and then strategic changes that we've made within the office. So we'll do a quick dive into each of these. Asset allocation accounts for 90+% of our performance. And what it ultimately is if you look at our overall portfolio, how much of our investments are in each asset class. So private equity, private credit, real assets, infrastructure, natural resources, public equities, fixed income. These are all categories that we are investing in. And what your asset allocation is, which again is set by the IAC, is how much of each asset we are targeting to be invested in. In 2022, there was an asset allocation study that was done that looked at what our asset allocation was. And the investment team, the IAC, worked with an outside consultant to set a new asset allocation, which was put in place at the end of 2022. And so we've been working to right size the portfolio to align with that new asset allocation over the last year and a half. This, again, is just a breakdown of what I mentioned. It's asset classes that we invest in. It is assets under management that fall within each of those categories. Then there is how much of our portfolio is actually allocated to each asset class right now. And then that last category is under our asset allocation, our target asset allocation, where we're looking to get in each of those asset classes. When that asset allocation was put in place, we have a 5-year pacing plan that maps out how we're going to hit those targets over time. And so this shows you a little bit about that. The reason this is important is part of our new asset allocation, we have a lot more investments in private assets. That being the case, what you want to do is be really intentional about how you are making those investments in private assets. You don't want to put all of your investments in private equity to get to that new asset allocation in 1 year. We want to make sure we're being opportunistic about what investments we're making and that we're diversifying the portfolio over years. We want to make sure that those vintage years, which you can almost think of as wine. So for private equity, for example, there have been some really strong vintage years in private equity, just like there are really strong years for California cabs in certain years. What you want to do is diversify when you're making those investments so that you're not betting all on 1 year. What this shows over time, though, is where we started when that new asset allocation was put in place. It shows where we are in terms of moving toward that new target asset allocation. And as you see, over time, we'll see a lot of our public markets, so global equities, fixed income coming down, and then a lot of our alternative assets increasing as we increase the portfolio on the private side. Again, this covers kind of our private market target allocations. And for the pacing plan in each of these private assets, it's showing how much capital we plan to commit to each asset class over the next several years to meet that new target asset allocation. It also shows what our unfunded commitments are. So when we invest with a manager, we make a commitment of a set amount of money, and that manager, as they find investment opportunities, draw down on that commitment. And so we have to account for that as we are talking about the pacing plan. What is going to be drawn down, and what we're going to be getting back from investments that we've previously made. So the next piece here is recruitment and retention. So this was a really top priority. We've had a lot of challenges with recruitment and retention in the office historically. Part of that being that we're in a really competitive market for investments, being wedged between New York and Boston. Obviously, in the public sector, there are folks that could be making more money in the private space. But what we wanted to do is make sure that we are recruiting and retaining investment talent, and that we are not losing folks to other public pension funds, which had been a challenge for us historically. We see this direct correlation between retention of investment talent and performance. If you look at a lot of the top performing pension funds, they've had the same CIO in place for many years. due to the work here in the legislature, we were able to pass legislation to make sure that we could be more competitive with other public pension funds, but also that we could build ladders within the division so that we would have talent that's in the office would be able to grow and move up within the organization rather than going to other public pension funds to advance. Again, as we talk about chronic, there was a 12-year window within the Office of the Treasurer where we had 10 chief investment officers. Really challenging to set long-term investment strategy with that turnover. And so this legislation and a lot of the work that we're doing to create a really strong investment culture within the office is having a really big impact. We've been getting more and more interest as we're posting positions. The narrative around the country for working in our office has really changed. And I think we're going to see that to the benefit of pensioners moving forward. I also will just mention, as I mentioned, vintage years in private equity, for example, there was a 3-year window where we had no principal investment officer for private equity. And so we missed those vintage years in terms of being able to deploy capital. These are the types of changes and things that we really want to avoid moving forward. Next piece here is just manager oversight. And so just quickly here, we've done a lot of work to vet managers that we are working with. As I mentioned, there's a constant monitoring and reviewing process. We have eliminated managers that have not met our expectation. We have some of those managers we have not re-upped with as they've come back up for future opportunities. But big picture here, our goal is to really reduce the number of managers that we're working with. I think we've been over-diversified from that perspective. And so the goal is to scale up with managers that we have high conviction in. What that also allows us to do is to get better benefits from the fee structure side and really to be more efficient rather than having just being over-diversified in terms of the number of managers we're using. We also have a watch list process. So if there are managers that, one, are either underperforming from a performance perspective, but also if they have qualitative concerns that we might be looking at, changes in management, a lot of people leaving a manager, those are all things that we would flag and that we make sure we're monitoring around the managers that we're using. And so this is a constant process. We're doing a lot of work on this front. And we're really seeing a lot of benefits in that already. I think the team has done an incredible job with manager selection, and we've seen that from a lot of the outperformance against our benchmarks. This is just some of the strategic changes. So as I mentioned, the investment policy statement, which was a huge, it is ultimately the guidelines for all of our investment strategy. That was approved by the IAC at the end of 2022. And so that includes changes, around our asset allocation, but it also includes guidelines around how much we can invest with an individual manager, what our proxy voting guidelines are, all of those pieces that really govern the work that we do in the office. We've created a risk mitigation portfolio within our asset allocation. We have a rebalancing policy. And again, we've updated a lot of our proxy voting policies. We are constantly working with the IAC, with the investment team, making changes to the IPS. But this is really important work. And this is all things that have been implemented in the last several years. Coming to the end here. So this is a slide that would also look familiar. This is market value history. So 10 years, and really just shows the funded status and the growth within our pension funds over the last 10 years. Kudos to the legislature for the work around really getting our fiscal house in order. Through that process, we've seen nearly $8 billion of additional contributions go into our pension fund, which has really been huge. I mean, a huge part of this is obviously performance, making sure we're maximizing the opportunity with resources that are in our pension fund. But it's, again, also making up for this really big hole that we're digging ourselves out of after not properly funding our pension for many years. You'll see under that our current funded ratio, 52% in our state employees retirement system and nearly 60% in teachers. And this is the highest funded ratio that we've had in many years. And this reflects a lot of process. As you can see by that chart, we were at a spot where we were in the low 30s for funded ratios not very long ago. what this is doing is saving taxpayers hundreds of millions of dollars on an annual basis that would be needed to be contributed to ADAC, but it's also allowing us to deploy these resources in a really strategic way, and to be opportunistic. And so as we think about our long-term strategy here, this, really paying into our pension funds, maximizing performance is having a really big impact on the state overall. And lastly, I'll just say this is contact information. I think everyone here knows how to get a hold of me in the office. Our goal always is to be collaborative and to have conversations. It's why it was important for us to pull our entire investment team together, inviting legislators over, why have had many sit downs with individual legislators while we're doing this work about engaging with the public. We are always open to those conversations and anything that is going to help to move our pension funds forward. And so anything that you ever need, please feel free to reach out to the office. If there are ideas, if there are recommendations, we're happy to discuss those and to make ourselves available to be helpful however we can. So appreciate the time and happy to take any questions you may have.
Thank you, Mr. Treasurer. I want to just first, you have given a number of, particularly to legislators, presentations in your office that I attended and found to be, very helpful and a great opportunity to engage in a deeper conversation. And some of the conversations that I had, in fact, I think I blew through my next appointment because I was hanging out there a little bit too long. Basically, you have a good story to tell in terms of the returns that are happening in the office and some of the changes. And some of my questions then, and my sort of remaining concern, is to make sure that the good things that are happening there are durable. That they aren't just, sort of anomaly or, timing issue, like we happen to be performing well today, but next year it might be different. So a couple questions. First of all, one just overall question is pension, like when you rank the performance of the pension funds and talk about where Connecticut fits, how volatile are those rankings?
So it depends. Again, this is about where our numbers are, which we're looking at. As long-term investors, it's really important that we're thinking about our long-term performance. And so where I think we've seen a lot of progress, and I think this is what I mentioned with compression, right? That if you look at some studies about where we ranked against peers a few years back, we are now on a 10-year basis in the 40th percentile for performance. We were obviously able to make significant strides in moving up against many of our peers over that period of time. And I think that's a signal of how much compression there is, but also how well we've performed over the last couple of years, right? And it's also why I say, looking at 1-year numbers, it's important to see if you're moving in the right direction, but that's not the standard by which we're really measuring our success. It's about stringing this performance together. But it's something we obviously closely monitor about where we are against peers, because I think it's helpful to kind of put it in context for everyone as we're thinking about where we are.
Thanks. And I know the next presenter has a report with a number of recommendations in it, and I wondered whether some of those are from, most of those I think come from a report from a couple of years ago. I wonder whether you could comment on those recommendations, any observations you had in terms of what you're doing now or what we ought to be doing.
Yeah, so and we appreciate the work of Professor Sonnenfeld with these recommendations. I honestly, we just received them recently, so I haven't been able to do a deep dive into all of them. And I think, he'll be presenting on these in more depth, so we'll certainly be able to hear out kind of more fleshed out versions. Some of them are things that I think are being done. And so some of it is about identifying where they are. I know one kind of with respect to how much we can invest in an individual manager, that is something that's built into our investment policy statement. I talked through some of our process in terms of continuing to review managers. And so, whether it's us developing a more formal kind of document that shows what that process is certainly helpful. But again, we're always open to what recommendations and thoughts may have. We have an incredibly talented team in the office that is working on this every day. We have our investment advisory council that is constantly bringing ideas and recommendations. And we work with a lot of outside advisors, not just on the kind of hired by the office, but peers and folks that I work with very closely as we're thinking about how to maximize opportunity My goal is, again, to make sure that we are building this out for long-term success. It's why our first piece of legislation was about strengthening the role of the Investment Advisory Council, making sure that we can have the right people in place to build on the talent that we currently have. And so we're always open to what those conversations may look like.
Thank you.
Thank you.
Mr. Co-Chair.
Thank you, Madam Chair. Good morning, Mr. Treasurer.
Good morning,
to see
Senator.
you. Thank you for presenting today and very helpful in your detail. Just to provide some perspective, you have 55 billion under management, you indicated. You also indicated about the 70 years in which the legislature failed and governors failed to address our responsibility towards pensioners. 36 billion in debt with respect to SERS and TERS and what have you. Our ADEC, our annual contribution from the appropriated funds is $3.3 billion or 7.5% of our budget. That's significant when we have people today, legislators today, wanting to invest in early childhood education, in housing, and a host of other things that that members are working hard to find revenue to achieve that. Some are not happy with the efforts that we undertook in 2017, the guardrails, so-called, to give us more guidance in how we appropriate funds, particularly volatile funds. That has resulted in $7 to $8 billion investment in reducing debt, and also providing us some $500 to $600 million in reduced ADEC responsibilities. So you can appreciate, I'm sure, that when we look at the other side of the coin, if you will, the treasurer's performance, and we learn that past, not under your watch, but previous, how I personally take responsibility as a chair of this committee for some time of never asking the questions, how's the treasurer's performance doing? And that's what, for me anyway, I'll speak for myself, why this forum is here today, because we've got some catching up to do. It does not mean that we are attempting to manage your office. But we have a responsibility to, as fiscal stewards, to know how are we managing the responsibilities of all those funds that we have under our guidance. And in fact, there are other committees that do the same. I mentioned the GAE committee and their responsibility, particularly in the Secretary of State's office. But this chart here, your asset allocation chart, for me, is very, very telling in how you have outlined where you want to go over the next several years. And I have to ask, prior to in some ways I look at this as we learn about how effective the manager in sports anyway, the manager or the coach was after he's been replaced. And I can't help but wonder, where was the Investment Advisory Council during that time? These folks who were supposed to be the watchdogs that sound the alarm, to use your words. Where was the mechanisms internally to address decisions, and who was making these decisions that led us down that path that so strongly underperformed?
So, Senator, first, just to address your first point, which I appreciate, I want to be very clear. I am happy to be here, and I appreciate the opportunity to present on the work that we're doing and the performance of this office. It's really been important to me throughout my time as treasurer to get out there and talk about this, because I think it's really important that folks are informed about the importance of the work that we're doing in the office and the impact that it has on the state. And so, I am always happy to do that. And again, will always be willing to make myself available to do that. As far as, and to be very clear as well, we have our investment advisory council meetings that we hold 6 times a year are public. And so you're always welcome to join those meetings to hear updates we do, even in terms of performance, peer comparisons. All of that is presented on in each IAC meeting that we do. They're open to the public. So that information, the materials that are provided, in-depth materials that are provided to all of our members of the IAC are all posted online. All of our regular performance numbers are posted online and available. We want to make sure that everything that we're doing in the office is open and transparent. As far as, historically, I can't speak to everything that happened prior to me being here. What I know, and the reason that I wanted to, as a top priority, make this change in terms of eliminating this potential conflict issue for the IAC was to make sure that we could tap into the wealth of investment talent that we have in the state of Connecticut for folks to serve on the IAC. The IAC is as strong as the members are going to be, and we have some great committed public servants that have put time into this work. We also know that we can build on that, and that's our goal right now. Ellen Schuman has been leading the charge on that. She has an incredible history in the investment space, including at the Yale Endowment and some of the other top investment institutions in the country. And we want to continue to build on that as we really identify the right people who can speak to asset allocation and high-level investment strategy. The other piece, and this was important about how we've worked with legislators, is that those roles are critically important on the IAC as well, in terms of keeping the legislature informed about what is happening on the IAC level. And so we've been working with legislative leadership in terms of those appointments as well. But, we know that there have been opportunities to improve. That's why this new asset allocation was put in place. And I think with strong members on the IAC, they remain diligent as we do regular evaluations of the investment policy statement, our asset allocation, to make sure that we're in the best spot to perform moving forward. The last thing I'll say is, I think looking in the rear view at times, I think it's important to know where some missed opportunities were. But I also think it's important to know that on a 10-year basis, we are still in the 40th percentile for performance. It's not where we need to be. And there certainly is more opportunity to improve where we are, to continue to put money into our pension funds. But in the landscape, we are still outperforming on a 10-year basis, 60% of other public pension funds above $1 billion.
I don't understand that representation when, at least in the Sonnenfeld report, which we'll hear from shortly, we are ranked second to at the bottom in terms of performance. I don't know how those two statements fit together.
So, and again, I have not had a chance to do a deep dive on that review. What I will say is my understanding is that the last update to that review did not include recent performance. And so I think that was numbers as of 2022, I believe.
But didn't you just say that we're talking about a 10-year look back?
So it's performance for a total of 10 years. From where we are going back 10 years, our performance has us in the 40th percentile. So I can't speak to, I think some of those numbers, maybe we were in I know when Professor Sonnenfeld's initial study came out, it was looking further back. And so that number had us much lower in terms of where our peer comparisons. We've moved up to the 40th percentile as far as performance against our peers. I think the other thing, and I don't know, and Professor Sonnenfeld, you could speak to this a little bit when you come up, but if this is looking at I don't know how many other public pension funds are in that study, because this 70 that I'm talking about are not just one public pension fund per state. It's about other large public pension funds across the country. And as I mentioned, California, for instance, you have CalPERS and CalSTRS, so their state employees and their teacher systems, which are very, very large, but operate completely independently.
Lastly, Madam Chair, Mr. Treasurer, again, your asset allocation for me is sort of like a Bible. I need to learn a lot more, but based on what I see here, I wonder if Ms. Schulman disagreed with the asset allocation prior to your arrival. And if you don't know that, if you could inquire with her, if she or others disagreed with that. And does that mean because in Connecticut, like North Carolina, you hold the sole responsibility in terms of final decisions, as opposed to other states that allow the investment advisory council to have decision-making capacity. That is not the case in Connecticut. So I wonder if previous decisions on asset allocation were supported by the advisory council or not recommended, but that the treasurer went forward and did it anyway. That information would be helpful, I think, to the committee.
Sure. So just with respect to asset allocation, that is an item that the IAC is required to adopt. So that is not something that I can do on my own. And just to speak to Chair Schuman, Chair Schuman was actually working with the Chief Investment Officer, a part of spearheading this new asset allocation study and asset allocation. So that was something that was done. There was a robust process in setting that new asset allocation. And again, was very much led by our investment team and the IAC under the leadership of the chair.
Do you know if there are times when the advisory council chooses not to adopt the recommendation of the treasurer?
So I don't know with respect to, I have not come across that. There is very robust debate, say when we are reviewing a manager, where there's
I'm
always,
speaking prior to your arrival.
I don't know that offhand, not that I know of, but
Thank you. Thank you, Madam
Sure.
Chair.
Thank you, Mr. Chair. Representative Cheeseman.
Thank you, Madam Chair. Thank you for coming here today, Treasurer. And this is sort of a follow-on from Senator Funfar's question. How often, certainly in your time, and it may not have happened, does the Investment Advisory Council disagree with the recommendations that are brought to them? And if they disagree, can you as a treasurer overrule them?
so I have not come across that yet. There are certainly will be disagreement at times about, not disagreement, but there will be skepticism about managers as we go into a meeting, which is the job of the IC, really, is to make sure that they're vetting our process, our diligence, right? Making sure that this is the best opportunity. And oftentimes as the team is answering questions, as we're able to address any concerns, the IAC is able to quells many of those concerns as we go through it. But you know, if the IAC were to move forward and not be on board with the recommendation of the treasurer, I think it would be a really difficult position for the treasurer to agree to move forward without that favorable recommendation, right? Which is why I think we have this process, why it's all public, where those concerns could be put forward. As far as things like asset allocation, those are things that we are very often working together with the IAC on. It's not a recommendation that's just coming from the investment team. The IAC, our outside consultant, and the investment team will be working collaboratively to set that asset allocation. And then what we do, which we've done at all of our IAC meetings, is we dig into constant review of that asset allocation, where the IAC can ask questions about any individual asset class, make decisions about whether or not we should move away from what our target is in private equity, right? And move more of that allocation to another asset class. Those are conversations that are constantly ongoing.
Okay, and I think part of my and not quite concerned interest in this area is, again, looking at past performance. I believe in 2012, Connecticut was the only pension fund in the country actually to lose money. Where was the IIC on that? And were, in fact, their recommendations, disregarded? But that, that's in the past. So you were talking about as managers draw down the funds and distribute them into investments. So is there a pot of, are they selling other investments? Is there a pot of money that's in short-term funds? How does that process play out as you are making new, reallocating your investments?
Yeah, so what we are normally doing for our private assets that are being drawn down, we are, if you look at our current asset allocation, we are overweight for that target on the public side. And so what we normally do is, as we are funding commitments on the private side, we're able to draw down from those public assets and then use those funds to fund privates as we are moving over to increase that allocation, if that makes sense. And so we commit X amount to a manager for whatever investment strategy we're hiring them for. And as they are finding opportunities to invest those funds and get strong returns for us, they draw off of that commitment.
So you are either liquidating existing assets in which you're overweight to make those funds available, or when the time is right, knowing you're over allocated, you liquidate and then put it in like a short-term money market fund or something like that. I'm just trying to get the process straight in my head.
So it's still within our portfolio, and we're constantly investing anything that we have. We do have a percentage of our portfolio that is always liquid, like cash, right? And so we're able to draw from those things as well. And I'm happy to get you specifics about what exactly, like what fund we would be drawing from a specific asset. But it's also important to keep in mind, we constantly have, funds that are coming back in from these investments as well, which we are able to, use to further invest.
Okay, thank you. I'd be interested in that information. Thank you, Madam Chair.
Thank you, Representative Cheeseman. Senator Fazio.
Thank you, Madam Chair. Thank you, Mr. Treasurer, for coming to join the Finance Committee. I wish very much I was there in person. Unfortunately, I'm under the weather and didn't want to get anyone sick. But obviously, I think it's very important that you were invited and that you joined us. You have a very big job, the state of Connecticut very much counts on the Treasurer's office to maintain its fiscal health. I mean, just the back of the envelope, $55 billion of assets under management. That means a 1% deviation every year in performance is $550 million, and 2% is $1.1 billion. And as Senator Fonfara said, there's a lot of people in need of funds for vital services, and there's over 1 million workers in the state who are significantly overtaxed, and the performance of the pension fund would significantly alter the trajectory economically of our state one way or the other. So you have a big job, and as I've said publicly before, many of the changes that you're making internally, I support and admire, and certainly voted for the 2023 legislation to improve some of the internal workings of the committee. So, we wanted to see you succeed, no matter what side of the aisle people are on. I think they want to see the Treasurer's office, no matter who's in it, succeed, and not just 1 year, but 10 years and 20 years out. That's the only way we can maintain a healthy state fiscally and economically. I wanted to ask roughly 3 questions. The first is obviously performance has been top of mind for us and for the public, especially since Professor Sonnenfeld and Jeffrey Tion issued their report last year. My understanding is that the 10-year performance that they published last year before 2023 had Connecticut in the bottom 5 for performance compared to other states. The update, I think, would probably have them have Connecticut in the bottom 10 because 2023 we were performed better, which we're all very happy about. And that was the one that's on your watch. The other ones are not on your watch. So that's the good news, which isn't to say a single person can bear all the responsibility or blame for any year's performance, but the better year is on your watch. But that, I think, only bumped us up under their counting from bottom 5 to bottom 10. So, it's very confusing, as others have noted, that you're citing a top 25%. So I assume that's because you're counting municipalities' pensions. I assume a lot of those are very different than state pensions, that they're much smaller. So my question would be, why not simply count Connecticut against the other 50 states rather than against dozens and dozens of municipalities and only a few states? So I'm just wondering why you would compare it to mostly municipalities instead of mostly states.
So, Senator, I appreciate the question. There are no comparisons against municipalities. The comparisons that we are offering, and again, this material is updated in our Investment Advisory Council meetings and materials every quarter that are provided by Investmetrics, which is an outside entity that collects performance data from public pension funds across the country and draws those comparisons with 70 other public pension funds. These are all pension funds that are $1 billion and up. And again, it's not just a state to state comparison, because there are several states that have multiple public pension plans that are large. And so we are and they operate independently as well. And so we make those comparisons against those larger public pension funds as well, because they are peers for us, both on a performance perspective, but also as we think about recruitment and retention of staff and compensation of that staff and all of the other things that go along with it. So there are no municipalities, if that's, those are large state plans that are being compared.
Okay, I'm very much confused because I thought the Investmetrics database was mostly local pension funds and not municipal local pension funds and not state pension funds.
No, we're happy to get you additional data so that you can see that. And again, those comparisons do, we have that material that's provided every IAC meeting. So we're happy to get you some of those comparisons to look
Okay,
at.
well that would be very helpful to see that database to compare it, because being in the top half versus the bottom 10 of states, it's a big difference when we're deciding when we're all evaluating the direction to go in. So I think that's very important to everyone on the committee, trying to figure out where we truly are compared to our peers. Similar question along the with regard to your analysis on benchmarks. I noticed in your benchmark of the 60/40 portfolio that you used the MSCI, a global equities index, and on for the bonds you use the Bloomberg, the U.S. Bloomberg benchmark. Was I reading that correctly? And if so, why use a global benchmark for equities and a domestic benchmark for bonds?
So appreciate the question, and the Bloomberg is a global benchmark as well. But that was the 60/40 that we provided the comparison on. And again, we do that on the global basis, understanding that as a global diversified portfolio, we want to make sure that that's the comparison we're looking at. I don't know, Ted, if you want to.
Yeah, the slide said U.S. The Bloomberg, the bond index was. I took a screenshot of it. Was U.S. aggregate, and the equities was global. Was a global average, and you had said before that you think things should be more global than domestic. So I was just, on the slide, it says U.S. aggregate for the bond index, and it says MSCI, which is global for the equity. So, I was just wondering why do one domestic and one global?
Right. Hi, this is Ted Wright, Chief Investment Officer. So we use that combination because that combination represents most of our public allocation. So we have a much larger investment grade portfolio that is very, very US centric. In our last investment policy statement, as far as non-US bonds, we even had a category of non-US bonds that we put that the Investment Advisory Council set a target of 0 to. So I think we have like about a 1% or so left in that. So hence that's why we did it that way. On the equity side, it has very much stayed a very, very global portfolio. I would say if we were to use a global equities portfolio benchmark and a global investment grade bond and benchmark, we actually would look a lot better, because the performance of the US investment grade has been so much better relative to the non-US side. Plus, it's reflective of how we invest. So again, this is to give you an apples to apples comparison. I mean, that's what we want. We want to be able to understand any given month, how do we look relative to our investment set, our opportunity set, not how we look versus how, some sector of the market. And I know you didn't specifically mention this, but on the global, on the equity side, just as a case in point, within our monthly reports, we do highlight the performance of our US equities portfolio versus US equities benchmark as well. So that is there. On a 10-year basis, we have one of the best performing US equities portfolio in the country on a public pension. And the Invest Metrics breaks it out for all $1 billion or greater public pensions, because that's who we compete with. I think our equities portfolio, just US equities, are like top 10% in the country over the last 10 years. So we have an outstanding track record in picking US equities, but on a global basis, it's just as outstanding.
Yeah, but so it sounds like you're benchmarking based on how you invest versus, so obviously it's going to track closely, but the question is that the correct benchmark? And I don't, maybe then you're a U.S. entity, so being heavily underweight as our pensions were U.S. equities until to very much to the Treasurer Russell's credit, we see our pension funds rotating more into U.S. equities, which is part of the reason we did better in the last year. But you're a U.S. entity, you're benchmarking your equities to global equities, and you're benchmarking your bonds to U.S. bonds. Why not have it be same? Why not have both be the benchmark for both be global or the benchmark for both be U.S.? I understand one or the other more easily than I understand one being U.S. and one being global.
And we do have that available. This is certainly a more accurate reflection of how we invest. But if we can always provide that. We just look a lot better if you just look at us versus if you look at us global equities and global bonds. Again, on the choice of benchmark, is always, and you look across any reputable public pension, it's always on the universe that you're investing in. So if we were only investing in US equities, then I would say by all means having a Russell 1000 or S&P is still, I mean, it's a decent representation, but a Russell 1000, for example, is a lot more broader. But that's how benchmarking is done. That's been done like that forever, and it is the right thing to do. You can't benchmark some fund against what they cannot invest in or where they're not invested. You have to benchmark them versus the universe that they have, that they can choose investments out of.
Okay, I don't want to belabor the point, but we can look at those numbers too. The treasurer also mentioned that there's going to be limits that I think maybe they followed or they've recently made reforms internally to place limits on asset allocation to certain managers. I think the 33% number was thrown out there. You just kind of clarify that, and see what, what happens if a current manager, you exceed 33% of their assets under management, and have you waived investing in any funds currently that are above 33%?
So that's at cost. So hypothetically, we could invest in a manager, and let's just say hypothetically, just for argument's sake, we could put 25% in a manager, and a manager has an incredible year and they're up 50%. Now we're 37% invested. So that's why it's at costs, not at market. So over time, we would strive to reduce our allocations when the opportunity comes. So if it's on the public side, we have a lot more liquidity where we can reduce that manager down to within that range again. If it's on the private side, it's a little more difficult because those are contractual obligations. And what we would do is when the opportunity come to, I know Treasurer used the term re-up, because funds have new series that they issue, we won't join the new series, in other words, or we won't re-up with the fund.
Yeah, and so have we dropped any that have gone above 33%?
So we've not re-upped with them because it's on the private side again. So we've not added anything. They've had new series, but we haven't re-upped. As what we've done is we've hired another fund that does similar things, that's a little different, but has as great a track record and a greater opportunity set, and that's where we've now deployed capital.
And have we waived the 33% limit on any that at cost?
Not to my knowledge, no, we haven't had to do that.
Okay. So for instance, Fairview, which was the fund of funds where we're over $1 billion of assets under management and over 80 or 90% of their total asset under management. I assume you're going to say that was at cost, that was lower, or obviously it was before, it was a long time ago, but we're what 90% of Fairview's asset under management. How does that play into the new limits?
Yeah, so again, that's at cost because we've been investing with Fairview, I mean, years and years before both of our times. So as you can imagine, over time, you will get some serious appreciation in the private equity world. But as far as re-ups, there's been a couple re-up opportunities, at least in my time, and we haven't re-upped.
Senator, I'm going to assume that that's your final question for the moment. We're happy to come back to you, but we have a number of other people.
I will stay on, and I would love to beg your indulgence for a second round after. Thank you.
I'll put you back on the list. Thank you. Ranking Member Senator Martin.
Thank you, Madam Chair. Very simply for me anyway, the current funding ratios, you made a comment that we were at the 30% for some of these funds, and now we're going, we're in the 52, 54, or 57, and then even the MERS is in the 70s. My question is, so what benchmark are you looking to get to for those funds? And what's your timeline to get to those? And then lastly, what can we do as a legislative body to help you to get to those benchmarks?
So, and I want to really keep this clear. So clearly for funding ratios, as everybody knows, we would love to be 100%. Everybody wants to be 100% because that means you could meet all of your future liabilities. We're not there, but we're moving in the right direction, clearly. One of the consequences of being underfunded is it can temper the way you invest. I mean, if at 33% or 32%, when I came here 2.5 years ago, we were in the 30s. And what I will tell you, because I came from a very large public pension that was bigger than this one, and much better funded, is you tend to be able to take a lot more relative risks and illiquidity risk. So like private equity, venture, when you're much better funded, because your obligations are so much less. So you can actually, you can go out a little bit more. In our case, we were faced with having a low funded ratio, which means that if we were to take on considerable amount of risks, that may work in our favor, but at the same time, if it goes south, we could go from 33% funded to 10% funded to bankruptcy. So what it calls for us to do, and just to answer your question about what the legislature can do, is to have a very supportive legislature. And when I say very supportive, who clearly understands that the name of the game in investing is it's a marathon and not a sprint. For us to get there, we need strong oversight. So the advisory councils led by Ellen Schuman, who I clearly respected before coming here, because she was an outstanding CIO at Carnegie. So it's in great hands, but also we need to make sure we have the leadership with the courage to say, let's hire the right people. Let's create a culture of excellence. Let's make sure that I used this term when Representative Horn was there. I said, when I look at the legislature, I think of football. As good as a quarterback is, he's nothing without a good offensive line. And that's why they're the second highest paid players in the NFL are those people. So we need to make sure that those things are taken care of such that We can bring on good staff. We have good oversight. We have great transparency. The treasurers made sure we had good transparency before. We have great transparency today. We've built a world-class staff. I mean, everywhere I go, I have people saying, your staff is not good, it's outstanding. And I do know that because I recruited people from the industry. And then the legislature's gone on to pass the ones of last year that I think are basically the glue to bring this all together.
And I will just say, I mean, I think a lot of the work that the legislature has done around addressing the state's overall fiscal health and continuing to pay into our pensions and making those required contributions, and obviously the additional contributions, right, is understanding that this is a marathon and it's going to take us time to catch up from the many decades of mismanagement. We need to continue that commitment moving forward about addressing a lot of these longstanding challenges. And so the work that's been done by the legislature to move us forward to continue to pay into our pension funds with these legislative changes really allowing us to impact performance in a positive way, that combination is going to get us where we need to go.
Thank you. I guess, there's so much pressure that's coming from different agencies and nonprofits, et cetera, wanting us to look into changing some of the guardrails that are in play right now. And then there's the other side of this of looking to make sure that we stay the course and making sure that we contribute or continue to be fiscally responsible and making sure that we address the unfunded liabilities that we've still have. And so I just wanted to hear more, again, what do you see the legislature needing to do to make sure that we accomplish getting to those target or the benchmarks of getting us from 50 now in the 50s and 70s to getting us to 100?
Yeah, and so I would just say, I mean, this obviously the guardrails have been incredibly effective, particularly around the work to add additional funds to our pension funds. We've seen the build up our reserves, really putting us in a position to withstand volatility in the market moving forward. We've seen these volatile revenues go into our pension funds, really bolstering our funded status. And frankly, they've helped us in terms of national reputation, our credit rating. I manage our credit rating relationships. I'm out constantly talking to investors who are the ones that are buying our bonds, who are investing in the state of Connecticut. And these guardrails have had a huge impact on those efforts. I think if you look at where we were some years ago, we are now in a spot where we are finally in a position to weigh out these interests. And there's always going to be that need to address our longstanding challenges while making investments in our communities, in education, in childcare. What I think is positive is that we're finally in a position where we're doing that from a position of strength rather than jumping from crisis to crisis, trying to figure out how we are going to pay our bills, right? And stay afloat. And so I think the legislature certainly has that job, and I think has done an incredible job working with the governor to balance those interests as we're putting budgets together. And that will be the case moving forward. But we certainly have seen the benefits of those additional funds going in to bolster our funded status.
Thank you to the both of you. Thank you, Madam
Thank you.
Thank you, Senator. Representative DeGraw.
Thank
Cover.
you so much.
Sorry, it's,
That's
brief-
okay, Madam. That's okay, Madam Chair. Thank you so much. And Mr. Treasurer, it's wonderful to see you even online in my case this morning. Thanks so much for being with us. I get a lot of questions from my constituents about where we are actually investing our money. Sometimes it's about whether or not we are still investing in any kind of gun manufacturing, but most commonly the question is about whether or not we're still investing in fossil fuels. In fact, recently, one of my constituents said, "Hey, do you think Connecticut's a good investment?" I said, "Absolutely, Connecticut's a great investment." The challenge is, after that, they asked me, "Well, what about, environmental issues? Are we investing in fossil fuels?" Because they didn't really want to put their money someplace where fossil fuels were being invested in. So that's my question for you. Are we still doing that? And, if we are, how do you see us moving forward towards a cleaner future in terms of investment?
Certainly, and I appreciate the question, and this is a priority of mine as well, to make sure that we can align our investments with our values as a state. And our approach, we have not made a net zero pledge here in Connecticut, but what we do is a lot of engagement around the investments we're making. We are obviously mindful of making sure that we are making investments that are not, detrimental to our communities and our environment. But where we are invested with companies that may be doing some of these things, our approach is engagement. Rather than divesting and losing your seat at the table and your opportunity to really influence what these companies or managers are doing, we've been really successful in that engagement with companies. One example was a company that I believe it was 7 or 9 coal plants that they had opened. And through that engagement with them, we got them to commit to closing all of those coal plants, which I think they are just closed the last one most recently. And so this is a priority. We do a lot of work around engagement around ESG due diligence as part of our due diligence process with managers. But our primary goal is making sure we're getting the best risk adjusted returns on our investment. And as we think about the environment, as we think about social and corporate governance practices, those are all things that have a long-term impact and are a long-term risk for the companies and managers that we're investing in. We want to make sure that we are minimizing those risks. And so we are constantly pushing on managers and corporations, understanding as long-term investors, we want to make sure that we're protecting pensioners over the long haul of our investment process.
Thank you so much. I really do appreciate that answer, and we'll be happy to take that back to many of my constituents. Thanks so much.
Thank
Thank you,
you.
Madam Chair.
Thank you, Representative. Oh, seeing nobody else for the first time, I will recognize myself for the second time. My prerogative. I wanted to return to your slide on asset allocation, in part because somewhat following up from Senator Pompeiro's questions, but I believe you yourself have said again today that focusing on this asset allocation and resetting it was a significant part of our improved investment returns. And so, first of all, I want to, as my understanding of asset allocations from other organizations in my own career is that they're not, they have bands, right, that you can operate within as you look at market opportunities. And so it's never, you're always slightly overweighting one and slightly overweighting another. So it's not a static thing. You're not going to hit a number and stay at it. And if you tried to do that, that's all you would do. So with that said, and with the also understanding that I want to endorse the fact that you have been relentlessly future focused, and I really appreciate that. And that is, sort of the best way to improve returns for the people of Connecticut. We do have to look a little bit back and say, okay, for whatever reason, whether it was incompetence, inappropriate political, who knows, we did clearly go astray for a while in the past. And so looking at the asset allocation, your slide in particular, my first question is, could you just clarify on this is slide 13 in your slide deck, interim policy A and interim policy B, what are those?
Sure. So the interim policies are essentially, again, looking at our pacing plan for getting to that new target allocation. Those, if you think about them almost as steps along the process, as where we expect to be as we are moving toward that new target policy. And there are blips that we are looking at. They're interim goals of about 18 months along in the process, 18 months, 3 years, kind of heading toward that 5-year goal. And sure.
Representative Horn, so when we put this together, and again, like you said, you have to kind of look back a little bit, right? So I'll tell you a little bit from my own history working in the public pension space. What typically happens is you have an asset allocation that's done by the board or committee or council or whatever, and then they set it, and then 3 years later they come back and they do it again. So one of my goals in doing this and changing up how we did this is I believe your duration or the time to look back or look forward is only as good as where you are at that moment. So rather than wait 3 years to set it, forget it, and come back 3 years, I said, let's put 2 interim targets so that we could have a roadmap to get there, and we could see how well we're pacing along this roadmap, put some bands around it, but it gives us points to check in. Now, to take it one step further, and I'm using best practices here to make it even more robust. And I think this is what makes our process even more robust than the ones I came from, which had phenomenal best practices, is we've instituted something called a structure review. We started it this year, where every asset class does a deep dive with the advisory council. Again, the advisory council is the one that sets the policies, the investment policy statement, which contains the asset allocation. So every asset class has to defend themselves in a public setting. And again, the advisory council can look at what they approved and say, well, given new information, given where we are in the world and the outlook going forward, do we need to make interim adjustments? So I wanted to get away from the set it and forget it that's normal in this industry, and make it one where we're dynamic, where the council can act so much more appropriately and have so much more teeth in making good decisions. But again, it's a collaboration between the staff, the council, and the treasurer. There's constant flow of information, and we're not outdated or dealing with an old policy that may be stale a year from now, because IA may have revolutionized everything, and we need to take a fresher look at certain things.
So that's really helpful. And sorry, were you?
No,
Yeah, okay. And I don't really think this is a question that you can answer today, but I think we'll want to reflect on whether there's something we should formalize about that to ensure that these changes, the good, healthy changes that have taken place continue to take place. Because I mean, as you know, Professor Sonnenfeld's report heaps a lot of praise on the current treasurer for the things that he has done in the office, but you are an elected official, and that could completely change in a few years. And so, I just would continue just continued conversation with you about looking at what's working, and are there things that we as a legislature should do to make sure that continues to happen, given your experiences.
And if I may add, Representative Horn, and I'll tell you, one of the challenges we as public pension staffs face is one, making sure we have the right support from the legislature, but two, from the people who work with us. Now, what tends to happen a lot, and we talk about those performance studies. So we've clearly moved from being a laggard in the industry to one that's respected in our business. But what could happen is, as soon as we get our sea legs, and I'm speaking from my old Navy, nomenclature, is that you have this analysis to paralysis going on. I did mention to you, I think we're sitting right now as a public pension in a very, very enviable spot. Where the challenges are in the investment industry, we are the buyers when the majority of public pensions are the net sellers. We're looking at great opportunities, and we have the opportunity to capitalize on it. What I would hate to see happen is that this progress stagnated, because we're overanalyzing the simple things and missing out on the more important things. My job is big picture. Big picture, we're in great shape. Big picture, I am chomping at the bits over the next 2-3 years at the opportunities that we are fortunate to be in because of some misfortune that may have happened before. And that's where I think the legislature comes in, really truly recognizing the power of what's been done in the last 2 years. We didn't magically went from being down here to up here. There was a lot of work going on. There were some brave decisions that were made. There were new processes that are there. These are permanent processes. These will outlive me. They're all there now in our policies. So those may not have been there before, but they're all there now. There's a watch list. There's a review process. There's a check and balance. There's when we do things, when we don't do things, it's all codified. So that's there as far as the durability. My hope is the legislature is one that's supportive to allow us to unlock the opportunities that are staring in our face today.
Thank you. Oh, well, I look forward to that continued conversation about that. As you said, I mean, I think part of what you suggest is that there is no answer to this. We don't like figure it out and then check the box and move on. It's a constant.
Yeah.
You know, markets change. We change. People sitting up here are going to change. So thank you. I appreciate that. And I know this is a sophisticated group today, but just a quick reminder, because there have been various conversations about additional information. If you do provide additional information, please send it to our clerk, Ash Northey, so that it can be distributed to the full committee.
Certainly, happy to.
And also just to note the obvious, as you see people come and go, there's a lot going on in the building today. People are leaving to vote, to caucus, to do various things. As I know, it's not lack of attention. It's just, attending to other business. So,
No, I appreciate that.
with that, Senator Fonfara.
Thank you, Madam Chair. Briefly, I hope, we have the second half of our presentation awaiting us. And Mr. Treasurer, I have to say that I think it speaks volumes to have your Chief Investment Officer here free to speak as he is, probably not knowing everything he's going to say. That takes some guts. I don't know if I would do it, but in any event, credit to you. Going back to the Bible, as I called it, probably what stands out the most is the change from in alternative investments. I don't know what that represents, but it's a significant change, even more than the global equity decline. But those are decisions that I don't know if that's coming from you, Mr. Treasurer, or the Chief Investment Officer, or a combination. But I have to ask, given the climate here in terms of your freedom to have your staff speak, where was the Chief Investment Officer, as I asked earlier about the head of the IAC, with respect to the allocation prior to you arriving in office? I know that Mr. Wright said he's been in office in his position for 2.5 years. So I just wonder, was there disagreement about that, given the significant change in direction that you established, Treasurer?
So I don't think that there was disagreement. So just so we're talking about, this is under the new asset allocation and our targets to increase those allocations to private markets. One thing I will say is, I think if you're looking at it historically, asset allocation, right? There's no like one right answer. And if you look at a bunch of different portfolios, their asset allocations are going to look different depending on that portfolio and where they are. Under our new asset allocation, we have this higher target for alternative investments. And what that is kind of the private market piece I was speaking to. So our private equity, private credit, real assets, infrastructure, natural resources. And so we have our pacing plan is ultimately focused on increasing those assets to private markets over this 5-year window. And that's where this changes. That was ultimately a decision that was set by the IAC in conjunction with our investment team. And this is, to Representative Horn's point, these interim policy points is where we are going to continue to reevaluate if that new target allocation is where we still want to be, or whether or not we want to make changes to that allocation as we move forward.
I understand that, but this is a dramatic, in my view, I don't see what's happened prior to December of 21, which might be interesting and informative, but I see a significant change.
Yep.
And that, I assume, is a philosophical, or maybe based on the performance in the market, that has led to this decision that wasn't prior to your arrival.
Yeah.
Is that correct?
It's a yes, and it's a result of the asset allocation study that was done and put in place back in 2022. I think some of this is the importance of these interim policies. My guess, and again, I wasn't in the loop on this, is that if we were looking at this asset allocation that was set prior to 2022, it was probably one that was kind of the set it and forget it that Ted mentioned earlier, right? Is that was the asset allocation that was in place, and that was the asset allocation that the investment team was following. I also think that this is where a lot of the other reforms that have been made around, one, making sure that we can have experts on the IAC with significant experience in asset allocation who are constantly looking at our high level investment strategy to weigh in on where we should be, but also the importance of having a really strong investment team within the organization that are also providing this feedback, making sure that folks are up to date. As I mentioned, we went a 12-year window where we had 10 chief investment officers. That is probably why some of these things did not move as quickly, or why a new asset allocation study wasn't done. I can't really speak to that. It was important for us to put these measures in place to make sure that we are prepared and have the right people in place to stay on top of these things moving forward.
This last remark, more than a question, I couldn't agree more with my co-chair, Chair Horn, regarding how can we have these be sustaining once you move on. You're a young man, you won't be in this job forever, and we can't write law about personality or competence, and I hope you would agree with that, which should not, and I hope is not seen as a reflection on our desire to micromanage you by any means.
No, and I appreciate that, and I hope you're not trying to kick me out of the job yet. I don't have any plans of going anywhere. And like I started this off, I am always more than happy and willing to sit down and have those conversations. I think many of the concerns, there are things that have actually been put into our investment policy statements. These aren't things that are just easily changed overnight. But I am always willing and available to have conversations about things that we can put in place to continue to move this office forward. As I started, my top priority is making sure that we as a state are prepared for long-term fiscal success. And our pension funds have a huge role in that, as well as the work that the governor and the legislature is doing to move our state forward. And so always willing to be collaborative.
Thank you, Madam Chair.
Thank you, Mr. Chair. Before I recognize Senator Fazio for the second time, I'm going to encourage, I know you have some other obligations today, so, and you've shared a great deal of time with us already. So encourage any additional questions to be efficient on the questions and on the answers. So with that, Senator Fazio.
Yes, thank you, Madam Chair, for the indulgence. Thank you to the treasurer for the indulgence. I will be brief for this time around. I'm obviously very interested in the topic because deviations of $1 billion in the state's returns year to year, I think is an important thing for us as a legislator to spend time on. And my kind of final one real question is along the lines of what Senator Fonfara was talking about, that we as a legislature can't be writing laws for individual personnel. And I think I'm optimistic that the changes Treasurer Russell has made in the past year are going to put our treasurer's office and pension funds on a positive trajectory, the rotation of asset allocation. But the very fact that we need to so significantly change our asset allocation is a concern in the first place. How could this go on for so long? And so it kind of gets to a fundamental question, which is Connecticut is among just a couple of states, New York sort of, and North Carolina, where fiduciary responsibility is mostly or totally vested in a sole elected official, the treasurer, which is way more responsibility than I think is fair to vest in any single individual. And obviously we have an IAC, but in the name, is the difference right there, that it's an advisory council. It's not a fiduciary body. And 47 states, I believe is the number, have decided to vest fiduciary responsibility on a shared basis in an investment board. Several people who can share that responsibility in the same way that almost every other multi-billion dollar, tens of billions of dollar private equity fund, investment fund in the country sets up their governance, that it's a shared responsibility on a fiduciary basis among several people, not just a sole individual. So I wanted to ask the treasurer, because I know we've had this conversation privately and they just want to, have the conversation publicly too, or Mr. Wright, is there an interest in exploring a different governance setup where you have a shared fiduciary responsibility among several people on an investment board for $40-50 billion, rather than simply an advisory council, whether it has some teeth or limited teeth, and a fiduciary that's an elected treasurer? And that's my last question.
Thanks, Senator. I appreciate the question. I know we have had conversations about this privately, and I'm always, I think, happy to have conversations again with anyone that would like to bring forward ideas or thoughts. I think the important thing here is to make sure that we're understanding the problem that we're trying to solve. And while there are few states that have this structure, I think what we have also seen in talking about our updated performance numbers, being in the top 40% for long-term 10-year performance, that the structure by itself is not going to necessarily impact performance. By those numbers alone, it means that 60% of other public pension funds, most of whom would have had boards, have underperformed us over that same period of time. And so if I thought that the solution was to change our structure overall, I would have been the first one to step in and do that coming into office. I think what this is about is making sure that we are making changes that are actually about directly impacting performance. The oversight piece of it is, I think, important, and it's why the first piece of legislation I brought forward was strengthening the Investment Advisory Council, who is ultimately tasked with that accountability and oversight for the treasurer. And so, I think even if you look at it from just a practical perspective, many of the changes that have happened under the leadership of the Investment Advisory Council over the last couple of years, working with our chief investment officer, would not have happened in this period of time had we had a board structure. It would have taken too long. It would have been cumbersome. And you can look at some other states that have board structures that have actually been really problematic for them. You look at CalPERS, for example. They have had the issue that we had many years ago, where there's this constant turnover of chief investment officers at the top. And part of that is because their board structure is so challenging. And frankly, you have political boards that are appointed, fiduciary duty or not, but it has gotten in the way of chief investment officers actually being able to lead the charge on performance in some of those places. And so certainly open to having whatever conversations members of the committee would like to have. But I think that I don't want to, again, let some of this desire to make change to impact performance get in the way of the work that's actually being done to improve performance.
Thank you for your time.
Thank you, Senator. Vice Chair Ferraro.
Thank you, Madam Chair. Hi to you both. Thanks for sticking with us. Following up a little bit on this comment around performance, but how talent really drives performance. Could you share a little bit more, because I missed your presentation and just wanted to hear a little more detail, particularly on how you all view the ability to recruit and retain talent, a key piece of performance? And is there anything, kind of to the chair's comment, is there anything particularly around the recruitment and retention of talent that we could do a better job about from a legislative and budgetary standpoint?
I really appreciate the question. And to your credit, there was already one big change that was made last year around recruitment and retention that ultimately gave me and the IAC more flexibility around compensation was one piece. Again, not that we are looking to set the market in terms of compensation for investment talent, but we want to make sure that we can be competitive and that we are not losing people to other public pension funds, which has been a really big challenge for us historically. What it also gave us the flexibility to do was to create new positions within our investment team. So we used to be really rigid. We had the CIO and deputy, we had principal investment officers for each asset class, and you had investment officers and analysts. And the problem with that is those are really big jumps between positions. And it didn't allow us to actually nurture and bring people along that may be very talented and experienced, but weren't ready to make that next jump. And so we would end up losing people to other places in order for them to get that advancement. What we were able to do now is we've created, working with the legislature and the IAC, we've created more positions within the organization so that people can move up, so that we can make sure that we can be more competitive with compensation for some of those people that really have strong potential and need more time. And so I think we're in a really strong place there. We're still in the process of actually building all of that out, and fully hiring the team. But I will say, we are in a spot where we have the strongest investment team that we've had, I would probably say ever in the state from what I know. And it is one where, as we are actually going out to the market to hire, the reputation around our culture and the people within our organization has significantly improved. And so we posted a position for our deputy CIO last year. We received almost 200 really strong applications for that position. That is unheard of for our office. And so you're really starting to see a lot of these changes. Again, these are things that may take a little while to fully flesh out, but we're making incredible progress. And I'll certainly be in touch as we think of anything that, action that the legislature can take to help us continue to move on that path.
Thank you for that. And just being able to share any feedback, you might have internally, or as you start to track how that talent really continues to impact performance, I think would be helpful for us to support that endeavor moving
Absolutely.
forward as well. Yeah.
Thank you.
Thank you to the chair.
Thank you, Madam Vice Chair. Seeing no further questions, I thank you for spending a chunk of your morning with us this morning and being open to all the questions. And I know you're available for more should we have them. So thank you for being with us.
Thank you. We really appreciate your time. Thanks.
Next up, we have Professor Sonnenfeld and Professor Tien. And I also thank you for spending your morning with us as we learn a lot in this process. Could you, sorry, sir, before you begin speaking, could you turn your microphone on? Make sure that the world can hear you.
I was
Thank
just
you.
going to say before I formally open, I was going to get my technology lined up, being the neo-Luddite technophobe on campus. Stephen Tien here is not only our research director, who I'll introduce, but also makes me look professional on the technology. But I am terribly honored to be with all of you, as Chairman Fonfera, of course, and Chair Horn, ranking members, Martin Cheeseman, Representative Farrar, Clarita Zitra may still be listening to us, as Senator Fazio, Representative Morin Bello. I'm trying to think who else we've caught up there. Is Representative Farrar, I think I mentioned, but and whoever else is watching on television, on Zoom, I certainly appreciate that. I know that the CBIA is meeting across the street. The governor is speaking right now. The bonding subcommittee is going full throttle. We should probably be ourselves over there applauding them, since it's funding our institutions, and so many competing things. The NBC News meltdown, mutiny on television. Certainly, some people watching on Zoom are watching that, or whatever else is on 500 channels. So I'm really honored that you have cleared this time for us to be here with you. But I'm also delighted, of course, to follow the treasurer. I think Treasurer Russell has, as we will get into it, has done a superb job, spectacular as a first-year public official, parachuting in, and Chair Schuman of the IAC. It is breathtaking that $55 billion surge in the pension fund is certainly attributed heavily to performance, and also to the thoughtfulness of this legislator in sending $8 billion into that treasury, which was this is certainly very important to help fund these pensions. and the 2% of employee payroll that goes into funding these pensions too. So I think we've come a very long way with some of the performance data that we'll talk about. We wouldn't say mission accomplished just yet, but I wouldn't have anticipated we would be where we are. I should say that we have Stephen Tian, our research director, is here with me as well. And Stephen, thank you for joining us. We also have Brian Sapione, who is assistant director of our institute in the back. We have Brett is with us, McMahon from JC Whitney, I guess the first venture capital firm in the country, and some other great friends here in the room. But let me just get into our presentation. I think given the very rich discussion you've had, I can race through this blizzard of slides quickly. I apologize to the legislators and anyone else who saw our slide deck that the update came through at 2:40 in the morning. I want to reassure you, if anybody didn't get to look at it, it will not be on the final exam. You don't need to worry. It was an optional reading. Last year, you got everything you should have needed. The heart of our recommendations and our research, you should have seen far earlier, and I'll just run through that, is that basically this is what we would have ideally covered in high-speed conversation to talk about today. Our purpose, seize the day, cover your rear. We're not here for the cover your rear. We'll speak very candidly. We don't have a career investment in our material. So we'll be respectful, of course, throughout and celebratory even, but there aren't any political sensitivities. We're not compensated. This was non-commercial, nonpartisan. It's consistent with my past role as the chair of Advanced CT, but I don't speak importantly for Yale University. I hope to have a job when I return after today. This is research that we did strictly as concerned citizens of the state. We'd been doing long-term research on Connecticut's extraordinary economic progress these past 5 years, which I know we don't have time to talk about today, but on education, workforce training, employment, financial stability, new business creation, venture capital, innovation, the overhang of pension funds, though it does continue to plague us. Despite considerable asset management and financial expertise in the state, Connecticut still has had some of the worst pension investment performance of any state in the nation, and our investment underperformance has improved tremendously, but the costs are real in terms of state billions, income taxes that could have been sliced in half, and other activities. We have a highly inclusive cross-sector set of economic development conferences that we've hosted at Yale in 2017 and in 2022, which we're told were the most inclusive institutional leadership in the 300-year history of the state, including both constitutional conventions. And they were very candid with bipartisan surfacing problems. There was a finger-pointing sensitivity to that back in 2017. What was remarkable in 2022, how enthusiastic people were with the state of progress, and we've documented in the extensive coverage here. There was so much good news, and we won't again get into that. But the lingering problem we found this back last year in October, when we saw that the pension fund is the one part of this that doesn't share in the success, and we thought, well, what could be going on there? So we did a 50-state comparison, pension fund performance, comparing Connecticut against peer states. For the first time in the history of the state, we don't believe any state has done this. We don't hold this state's officials responsible. It's shocking. It's a good business opportunity where we commercial to somehow create these 50-state benchmarks. But we painstakingly poured through thousands of pages across the 50-state pension funds, annual reports, carefully matching difficult timeframes, properly calibrating assets to avoid just what we heard in the earlier presentation of avoiding apples and oranges confusion and categories of classification of asset categories and things. And we found problems. Our team, they're expert in different fields, but they're students. but they have extensive applied math, economics, strategy, financial asset management, statistics backgrounds, and a good deal of prior histories in their early careers in public service, at more than 5,000 hours of unpaid service. We began this then, as mentioned, in 2017. And then September of 2022, we did this deeper analysis and found the underperformance. We thought let's do the 50-state comparisons. We did a year ago fall. Then in January, a year ago, 2023, we ran this through financial experts from around the country, endowment managers, asset managers, independent, to make sure that what we had made sense with the people who've been doing this for a living. And which I was a little disappointed to hear the treasurer say they hadn't had a chance to review it. We actually did everything that we're presenting today. The essence of it, all the research was presented to them twice in January, to the treasurer's office and to Governor Lamont's office. And then we sat on it for 3 months because we wanted to update the analysis and see that we have a brand new treasurer and give some time for a fair response. So we didn't release it for 3 months because we wanted, in fairness, to get some good momentum going, and they've done so, as we've said. However, it set off quite a bit of fireworks last May when we did release this research again that we had sat on for fact checking and for fairness of the administration of the new treasurer. And then we've been updating this fall some new data. What's come out is that there have been some of the worst mistakes in the nation, where we thought with all this asset management expertise in Connecticut, surely Connecticut was doing well. We had prior treasurers who I admired greatly for their candid voices in critiquing corporate governance failures across sectors. And I was shocked to find that these are the same people who had performed poorly in governance on our own front. I never imagined so. In short, our findings, while many attribute Connecticut's pension woes to irresponsible fiscal decision-making. In short, a lot of the political food fights that took place over decisions on taxation and on expending, that mattered, but it was incidental to the magnitude of what's happened here. This legislature spent an awful lot of time last May on funding a warehouse. If we'd gotten this right, we could have hundreds of thousands of warehouses. The way we have spent an inordinate amount of time taking a look at fiscal issues and not taking a look at the pension fund issues that dwarf that. The investment performance was chronically one of the very worst in any state in the nation. As of June 30th, 2022, Connecticut had the second worst performance of any state in a 3- and 5-year basis, and the 5th worst on a 10-year basis. Connecticut's laggard performance was not a 1-year fluke. It's nothing to sneeze at, not you. But rather a long-term historical trend. Through 2021, Connecticut still had the 3rd worst performance of any state in the nation on a 3-year, 5-year, and 10-year annual basis. Connecticut's pension fund manager, it's every 1%, I think, as Senator Fanfaro said, is more than $500 million. And 2% is about 1.1. And you layer on top of this underperformance, what it means, as state employees found out again just last week, that 2% of their income, no matter who they are, as sanitation workers, as school teachers, as firefighters and police officers, the 2% of their salaries are going to fix this continued problem that is still there, that is not fixed. So our findings, we see that again under the skilled leadership of our new treasurer, Eric Russell, and the chair of the Connecticut Investment Advisory Committee, Ellen Schuman. They've already helped improve the performance significantly. On a 1-year basis, Connecticut's performance was in the top half of the states. We salute them for that. That is absolutely right. We heard that just moments ago. Through 3, 5-year, 10-year, though, performance remains weighted down by the historic legacy, which is not the fault of Treasurer Russell. He's inherited this. And you're right to ask Senator Fanfaro about the last 2 years where this hadn't been changed, the last 3 years, but it has been changed now, and that's fantastic. We give tremendous credit to Treasurer Russell and Chair Schuman for implementing several key changes. The pension funds are clearly moving in the right direction, and we celebrate some of the things that we celebrate, they're restoring the professionalism to the operation. Their performance reports are coming out much faster. Other public materials are properly being updated, and the accessibility, which he modeled for us today, but which he also spoke to, is the real deal outside of this room as well. He is as accessible as he is eloquent. Changing asset allocation towards a more normalized mix of assets, reversing mistaken decisions such as the underweight U.S. equities and tragically overweight emerging markets until quite recently, say in Chinese equities, hurt this state badly, but we're getting out of it. So good for them. Beginning the process of pruning underperforming external asset managers, focusing on allocating towards high quality external managers. I believe that Senator Fazio was asking which ones, but I guess they say they're doing it. We just didn't learn who they've pared down and how much of that is continuing along. But at least we've spoken to the issue here, ramping up the use of passive index funds where possible to minimize redundant excessive fees. We might stand uniquely alone as a state that actually pays money on on money that is just not being managed, just parked in a bank, just the designated funds. Nobody else does that, and paying fees on top of fund-to-fund managers paying management fees on top of that. That's got to stop, and we're making progress towards that. Clearly and transparently communicating with the public. There's still more that needs to be done, though, and here's the recommendations. First, independent oversight, regularly providing performance reports benchmarked against the performance of 50 states using commonly accepted financial benchmarks by a majority of other states for each asset class. And this is to prevent, where we just closed off in the prior discussion, arbitrary selection of obscure financial benchmarks without benchmarking peer-to-peer states as best practices. We can show you it isn't just an issue of apples to apples. We have fruit juice going on. We have apples and oranges jumbled together in the same funds. We have changing goalposts. Sometimes we use the Russell 2000. Sometimes it's the MSCI. Sometimes it's the S&P 500. And slides, as you pointed out, that are labeled as domestic are using global indices. We should just use standard criteria and keep it consistent the way others do. Independent oversight by review by auditors that report to the General Assembly. I should also mention, and I believe that Senator Fanfara knows this, that many of these recommendations were proposed 35 years ago in 1989. We didn't plagiarize them. We promise you, we didn't lift them. We've discovered just recently that some of these ideas were floated by this legislature, by outside consultants to this legislative committees, and they didn't happen. What happened right away? That was before we had an income tax. Because we didn't implement them, this state promptly thereafter had to introduce the income tax. It was, as you know, in the early 90s, and it's really a shame. This whole state would have been a very different situation if we'd had the wisdom to listen to the advice of recommendations such as these that were proposed 35 years ago, and that's when our performance was far stronger. We have cumbersome performance reports that instead of clear, simple dashboards, the way public and private boards use regularly, you have a set of charts that you look at to see how you're doing, rather than 600 pages to have to wade through. Establishing clear, reasonable criteria for replacing existing underperforming external investment managers. And I believe that they're sincere that we're doing it. Those criteria, I don't think anybody I'm facing right now could tell me what those criteria are. And I think if I gave you 5 hours, you also still wouldn't be able to tell me what those criteria are, how you would find it. We should know what that is. Find a simple list on a website and things. Establishing clear, reasonable criteria goals for limiting our exposure to any single external investment manager. Well, limiting to a third is a good idea, but we're well above 60-70% right now with several asset managers. And we have one asset manager that invests 90% of our venture capital money is in one asset manager. And you say, well, okay, well, they have a second asset manager there. Great. They have the other 10%, but that's not minimizing the state's risk. Statutorily empower the IAC with fiduciary responsibility rather than purely advisory. 7, prioritize unnecessary, redundant, excessive fees paid to external managers. We've had consultants and internal people complain about this. I think it's very likely, although I have no data to support this, that the high turnover we have seen in chief investment officers, when we take a look at dissatisfaction in staff reports in the archives and consultant and advisor and auditor complaints about past practices, that many of those people could have left because they were demoralized, not because they were underpaid or the wrong people hired. It looked like there was a good deal of frustration. Continuous shift toward low-fee passive index funds and establishing statutory eligibility requirements for future treasurer candidates. Just to give some background, with independent oversight, we can provide performance reports, benchmarks against the other 50 states. It's often too arbitrary, and we just saw that. Okay, we just saw a map. A map was presented that none of us ever saw before. It was a map of all 50 states of the United States. Would anyone disagree? And it follows this statement, which came out of the Treasurer's office just last Wednesday night. This says Connecticut's pension funds earned returns of 12.8%, the top 27% of the nation's pension funds across the nation. After seeing this posting or hearing the presentation we just heard, I don't know if it's fair to ask the four of you or anybody else in TV land, would anybody disagree that the message here is Connecticut is in the top 27% of all 50 states? Does anybody disagree with that? That's the message here?
Sorry, we're asking the questions.
Okay,
I'm not
I
gonna
know,
let you be
it's not fair.
rhetorical.
It's the school, nasty school teacher information. Yeah, so, well, having heard no dissent, no, is well, no, the treasurer himself, I honestly thought, I believe, but mistakenly said it's 50 states. It's not. It's benchmarked against 80. We went back to the consultant and the consultant's database that's drawn on. It's not 61 or 70 funds. It was 85 funds used in comparison. 70% are local municipality pension funds, not state funds. Durham, North Carolina, the fire department and New Haven fire department, they're all over $1 billion funds. They don't have any of the guidelines and goals and things of investment that we do. They're not the 50 states. They're probably representing a dozen states, these 85, not all 50 states, despite the map you saw and despite the release. And again, this is not that anybody's trying to be deceptive, but here's what's in the database that this was not presented to you 20 minutes ago. But here it is. This is not all 50 states. These are local. These are local. These are local municipal pension funds. That is not what the public was just told in that release or in the testimony we had just moments ago. And we see these shifting benchmarks. We should, whether it's the Russell 3000, the Russell 2000, the S&P, MSCI, and of course, this consultants database, which again is not 50 state database. And we take a look at, well, why do we do this? Well, if you, I'm colorblind, but the gray bar here is the Russell 3000. Well, that's and the blue bar is where we are. The standard used for private investments, for venture capital, private equity investments, is standard by anybody in the industry is the Hamilton Lane Index, and you can see we consistently underperform that Hamilton Lane Index. So therefore, instead of using that as the benchmark, we see, well, there's one time on a 5-year basis where the blue line beats something. It beats this, irrelevant Russell 3000 that is not the standard return for private benchmarks. What in the world is the Russell 2000 being used, Russell 3000 being used when we're looking at these private venture investments? And by the way, this is the bad news that just sort of reminds us what our employees have to pay because of these poor decisions. This is 2% being docked of every one of our employees throughout the state. Performance reports, they're thick. We've gone through them. It takes a lot of time. I don't know how many people in this room have been reading each of these 6,000-page reports. Simple gauges should complement them. It doesn't have to actually be gauges, but a dashboard, of course, that has a couple of graphs. That's what you see on every public and private board on which I serve. And I could name them at Advanced CT and Connecticut Innovations. We're not giving 6,000 pages. We're looking at dashboard data, external poor performing managers. We have a list of them. We have people that are feasting off the state. They're not performing well, and they have been with us you take a look at a long period of time of acute underperformance. is you take a look at this, you put somebody, we have people with us who've been with us for over a quarter of a century of underperformance. And I'm not targeting any single fund. I want to shout that from the mountaintops. We have at least, this is a sample. And just this sample is 30. So if we've been pruning, great. Which ones did we prune? Because again, this is a lot of committed capital underperforming. We should be getting rid of, and we do match it by vintage year. We're not like cherry, do apples and oranges comparisons. There are good and bad performers by the vintage year. We need to limit the exposure to any single external manager. We haven't done that yet. Certainly the venture capital portfolio is an example. The IAC should have statutory authority. That's right, if we're going to prioritize, we need some priorities, is Connecticut's one of only 2 states in the nation. North Carolina, who's the other state? They're the other one that has the second worst, the worst performance in the nation, as do we. They're the poorest performer, and we match them. When the treasurer said, well, some of these states that have most states in the nation that now have an investment advisory council that's more than advisory, but actually shares fiduciary duties. Well, that could lead to staff turnover. We just heard we had tremendous staff turnover without that. So it doesn't seem like that is what makes the difference. 47 states vest their fiduciary duty in a board rather than appointed or elected by state. Connecticut may soon be the only one that has a treasurer with no checks or balances. And I think we have a very honest, smart, eloquent treasurer. I think we're very fortunate the treasurer we have. But I do believe, as has been pointed out by Chair Representative Horn, that this treasurer may not be our treasurer forever. He may move on to something else, and we need to make sure that we have proper checks and balances, and not be the only state with sole fiduciary responsibilities. And then getting rid of the unnecessary fees, excessive fees that our consultants and auditors to the state have complained about them. They've continued on. Nobody pays management fees to somebody who's forking everything out to fund managers to pay things that are paying layers and layers of fees. People don't pay fees for money that is uncommitted, that's sitting in the bank, that's not being invested. And then continuing shift towards index funds. And probably last, we should say, I cherish barbers and haircutters, but it is far higher in this state, higher bar to be licensed and eligible to be a haircutter than it is to be the treasurer of the state's funds. There's no eligibility criteria. The attorney general and others. And by the way, this is not a unique problem to Connecticut. I think most states have not really developed criteria around that. So again, we have no agenda, professional motives. We have no career agenda here. If you never hear from me again, that might be really happy to you, but I won't be disappointed. We just did this as public servants, and I'm sorry to talk so fast and give you the blizzard of slides. And there's still people left in the room, though. Somehow, maybe you're serving lunch, but seriously, thank you very much. And let me stop for any questions. And the brains of the gang here, Stephen, will hopefully answer them. Is seeing Mr. Wright join the treasurer seemed like a very good idea. We'll follow that model.
You did preview that you were going to storm through this presentation, and you certainly did that. So I apologize that you felt that you needed to do it so fast, but there's a lot in there. I know there will be lots of questions. My first question that I would like to frame is just a lot of your recommendations have to do with how we, transparency, essentially, how we present the information. Do we do it in a consistent way so that people can make decisions and see it? What is the information that or the way it's presented here? Is it presented to us in the same way that the IAC is getting the information? So is the IAC also getting muddled information per your analysis?
In fairness, we've never attended an IAC meeting. We should have, and they're open. So shame on us. I do think that the reporting we've seen looks comprehensive, but it's the use of these benchmarks where I think the IAC, any taxpayer, any legislator, and school teachers like ourselves would be confused. So people and the IAC could hear that they're top 27% in the nation and think that means something. We're actually no longer the second worst in the nation. We're the 8th worst in the nation. That's the truth based on a 50-state yardstick. But if we only had one of the two presentations today, that's what the legislators would walk away with. And I think that's unfortunate. Stephen, you want to add to that?
The only thing I would add, Madam Chair, is the IAC info packets tend to run 500 or 600 pages if you find them online. They are extremely dense, even for folks who have content and background in this space. It's not easy to find the information you're trying to find in 600-page info packets without a table of contents, mind you, with things in rather random order. So it is not at all an accessible format, even for folks with experience in the state, much less the state employees and teachers, who are, of course, the folks who are benefiting from these investments, who probably have no idea what to look for in these 600 pages.
And just a point of clarity, because we will, I'm sure, have follow-up questions for everybody concerned after this. Your, when you said we've gone from being the second worst in the country to being the 8th worst in the country, that is based on as current information as you have access to, is that right?
As of June 30th, 2023, based on a 50-state comparative analysis. And this is a point I would like to make some comments on.
What time frame, Stephen?
Over a 1-year, 3-year, 5-year, and 10-year time period. I'd like to focus in
But
on
this
this.
past year was very strong.
Yes, correct. But the long-term performance is still weighted downwards because of the long-term underperformance. I would like to make a comment on this, as this has come up repeatedly from you, Madam Chair, as well as from Chairman Fonfera. The treasurer says that we are now in the 40th percentile, I believe, in terms of 10-year performance. That calculation actually is in the most recent 600-page info packet. It's there. And we looked it up. And if Jeff can go back maybe just a couple of slides, it is the exact same database that the treasurer said. It is the Makita database with the Invest. Here we go. This is exactly it. This is the Makita database. We have access to it at Yale. It's the InvMetrics database of public pension funds with assets greater than $1 billion. We took a screenshot of this database, and you can literally see in the column that's highlighted in the red that most of these funds that are being benchmarked against Connecticut are local municipal funds. Now, with that being said, the 40% percentile performance over 10 years benchmarked against local municipal funds, it's not exactly an apples to apples comparison. Most local municipal funds do not have the resources, do not have the scale, and do not have the support of state pension funds. It's really a different ballgame. So looking at Connecticut's performance relative to other local municipal funds and saying we're in the 40th percentile over 10 years versus over that exact same time period, benchmarking against 50 state funds and saying we're in the bottom 8, that's a very different comparison. And that tells you very different things. The other point I would add to this is even within the so-called state government funds in this Makita database, as the treasurer said, and he acknowledged this readily, you have from the same state, you have multiple pension funds that are being counted as separate funds within the same state. We don't do that when we benchmark against 50 peer states. We take the aggregate performance for each state across all of their pension funds, and then we compare Connecticut's aggregate performance against that. In the cases where aggregate performance is extremely difficult to calculate, which there's a few, we take by far the largest core pension fund in that state, which is a much more reliable apples to apples comparison than taking multiple funds from the same state and counting those as separate data points. That's why there are 85 such data points in this database, even though obviously there are only 50 states. And again, most of those 50 states are not represented in that database. So that helps explain some of the discrepancy in terms of the statistics you might be hearing, whether Connecticut's in the 40th percentile of 10-year performance, whether we're in the bottom 8 over that exact same time period. It matters who you're comparing yourselves against.
Yes. So obviously there's some subjectivity in terms of what we should compare it to, but there also seems to be a fairly stark factual, different factual assertions about this particular database, which this not being a trial, we're not going to resolve today, but
We
but
thought we had, it was presented
but
erroneous.
it seems to me that we should, right, we should be able to take a look at that and come to, that's a knowable fact. So we can look into that.
And again, that's not to say that this past year's performance was not excellent, that we're no longer at the bottom of the list. It was definitely in the middle of the list, middle of the pack, which is a huge improvement. For this
Yes,
one year.
and obviously if you are measuring, changes that have only had, a year or two to be in place, as you have noted, if you're looking at a 10-year look back, obviously that's weighted down by a different policy. And so you
Right.
have to, we have to look at the 10-year, but it's got asterisks attached to it. So we've lots more questions to come. Senator Farah.
Madam Chair. Good afternoon, gentlemen. Thank you very much for your patience. I thought the colloquy with the treasurer and his presentation was very helpful. I'm glad you stuck it out to give your presentation and answer some of our questions. Professor Sonnenfeld, first of all, let me say that, as I mentioned with Treasurer Russell, I take personally, not that anyone else can't, but I take very personally the responsibility or the failed responsibility to ask questions about the performance of the Treasurer's Office in previous years. I never did. And I found this report that you cited earlier on program review and investigations, which is now defunct in the legislature, about midnight last night. That's my life. But in any event, it does speak to a number of the things that in your recommendations and what's been discussed here today, and that that many, if not all, have not been adopted, particularly about providing more information to the public, other issues of hiring external managers and fees, and those kinds of things. Overriding for me is, what is our role as a legislature in this process with respect to the Treasurer's Office and the performance of the Treasurer? Understanding that it's a constitutional office, understanding that they have their responsibilities, but we have ours. And we have not met that charge historically here on this committee in particular. We don't have a program review and investigations committee any longer. But they decided to, as a matter of fact, I'll take some more lashes for the fact that I chaired this committee for a number of years. And it didn't dawn on me at that time to ask for an update in this 35-year-old report. So I'll ask you if you'll be so kind to help us. In your opinion, what should we put a bill forward that would have call for an independent analysis of the performance that is for our benefit, so we understand more in more probably layman's terms, hopefully, for those of us who may not understand every nuance that is presented in a report from the treasurer, and with recommendations as to how that performance could be, but not have to wait until, forgive me, but Yale comes forward, you and your office comes forward with a study, which frankly, if it hadn't been publicized, I wouldn't have known existed, and we probably wouldn't be, I don't know, maybe, Madam Chair, you would have initiated it. I would not have if I did not know. And so I'll yield the floor.
Thank you. I don't think a Princeton graduate would have called Yale in to come to the rescue for sure. But I do think that we can Connecticut can do better. And so often we hear of business leaders who like to point accusatory fingers at government as if things are always somehow better in the private sector. They're not, of course. And this is one area where, while Connecticut hadn't done well, neither has the private sector, is in terms of who hires auditors in the private sector. And sadly, since even the 1930s securities legislation that helped create the auditing business to be such a successful industry. It is the leadership, the CEOs themselves. So while I do believe our auditors, our CPA firms try to be honest and independent, it's still the people who hire them and pay them, will switch firms if they really think they're getting bad reviews. And that's problematic. In government, however, you have something like the General Accounting Office that will report to Congress, and it's not beholden to the agencies that it reviews. It's not always perfect. We have inspectors general who have sometimes been brutalized and politicized in recent years, but usually those inspectors generals by unit also have some degree of independence. So I think the original legislation, Senator, you're referring to, or certainly what I think you might be have in mind right now is an excellent idea, which is that there be an independent audit that is reported to the legislature, and maybe an investment advisory committee that has a statutory authority, and maybe in the comptroller of the state too, but certainly the legislature it should have it reported to directly. Therefore, we wouldn't have been surprising you with information of complaints from early reviews, auditors, and employees about the retention of poor performing asset managers for decades.
And in fairness, I understand that the way you came about this study is part of your annual review or biannual review of Connecticut's economy, and then found this area to be needing further examination.
That's right. The way we actually got into it is, I don't know, 5-6 years ago when General Electric pulled out, there was so much finger pointing. I wanted to understand how we could all help. And we started to see where some of the areas the problems were. And then we did an update 4 years later, where again, as we did before, the teachers unions, the AFL-CIO, NEACP, the community foundations, and the healthcare, biotech, real estate, manufacturing, aerospace sectors. Everybody was there in the room, and the spirit was so remarkably improved from where it was 4 or 5 years earlier, except on the pension front. And people kept, people pointing to the transfer of $8 billion to try to make us whole, and that still wasn't enough. This pension overhang, but we didn't want to showcase the issues back then until we really researched it on a 50-state basis. So that's exactly how we got into it. Is we've just been concerned about how to help our state, as we've seen progress on and just about every other front. We could do a little bit better on housing and this or that, but on employment and venture capital, innovation, R&D, this state is so much better than the press has been around the nation about Connecticut. But when it comes to pensions, it's been a needless problem that has had deleterious effects. It's leading attractive employers to leave, many citizens to leave, and just because some of it because of taxation that was unnecessary. Had the Treasury supported the pension funds the way it does in other states.
One last question, Madam Chair. With respect, and you can provide this to the committee if your answer is longer. With respect to your recommendations, are any of those that are pretty much accepted policy in other states regarding information or structure, policy, guidelines that legislatures have passed regarding the Treasurer's office in those states?
Well, the fiduciary responsibility of an advisory council, the treasurer is absolutely right. It's not a panacea. Plenty of poor performing states have that structure, but that still it's not a necessary but not sufficient condition alone. Stephen, would you want to address that?
Yes, Mr. Chair, plenty of other states have much more accessible reporting. I mean, we don't have the data on that, but I can just tell you from having looked up these 50 state performance reports that it is much easier to make sense of plenty of other states' performance relative to our own. Plenty of other states also have more legislative oversight. In terms of, in fact, some of the best performance documents were actually legislative oversight documents from some of the other states. It wasn't unusual to find that some of the legislative documents were actually better than the pension investment's own performance reports. That was not an unusual phenomenon. I couldn't quantify that, but from my qualitative experience, I can say that definitively. As for some of the other recommendations we make, for example, replacing and exiting underperforming external investment managers, limiting our exposure to any single external investment manager. Most other states have much more stringent requirements than we do. To, again, Treasurer Russell's tremendous credit, he's overhauled the investment policy statement. He's implemented some of these thresholds, but for a long time, Connecticut did not have these. And given our governance model of the sole fiduciary, if Connecticut were to ever have a treasurer who is not Treasurer Russell, who might want to change governance models and go back to what we saw over the past decade, we might be in a situation where we not be continuing some of these best practices. And obviously on, for example, shifting towards low fee passive index funds and reducing fees paid towards external managers, those widely, again, those are usually widely codified across most other states as best practices.
And the state's consultants have complained to the treasurer's office in the past who are overpaying on fees. And I doubt that information was reported to you, but it's there. And we don't often see the entirety of just about the entirety of a state's venture capital fund in the hands of a single asset manager, and one that has been consistently underperforming and the subject of complaints over excessive fees. That's just not common. And to have dozens and dozens of poor performing asset managers with us for over a quarter of a century, it's at some point has to ask a question, that don't we need better investment advice? So yeah, that's it is, and it's embarrassing that it's Connecticut with all the expertise that's here. This just shouldn't have happened. It shouldn't have continued, and we're not pointing fingers. I think any people responsible aren't really around anymore here. So it's time for a fresh start, and I think this treasurer signifies it, and we just like to accelerate that.
Thank you both very much. Thank you, Madam Chair.
Thank you, Mr. Chair. Representative Cheeseman.
Thank you. And I suppose my questions, comments are a follow-on from your recent comments, Professor Tang. With regard to how do you develop those criteria for making the decision to exit the underperforming managers? And I believe you said that in a number of states you looked at that was specifically codified by the legislature. Am I understanding your comments correctly?
Well, Representative Cheeseman, thank you for the question. The extent to which it's codified is different across states, but yes, there is at least some baseline for pruning and removing underperforming managers for the most part.
All right, I'd be very interested to look at the information you found about what different states are doing. And again, if you could share that information, the committee through the administrator, that would be great, because I'm a great believer in if there are good ideas we can steal from other states, why not? With regard to moving to more index funds, obviously there are a huge variety of index funds. So you see a move toward that more passive investing across different sectors as a way of having so many actively managed funds as a way to both maximize our investment and save state dollars?
That's right. Representative Cheeseman, every year the pension funds pay over, it depends on the year, but for most years, the pension funds pay over $100 million in fees alone to external asset managers. $100 million is a lot of money, obviously. So the more we can reduce that, the better. And in certain asset classes, specifically, for example, equities and fixed income, there are a lot of empirical studies that show that frankly, active managers do not outperform the market in those asset classes, and having a pension, having an index fund in those asset classes would be the most effective way of generating market returns while paying the lowest fees and the lowest overhead.
If I could add to Mr. T, and just so he doesn't get in trouble, he's not a professor.
Oh, sorry, my
No, it's
apologies.
generous of you, but we'll get in trouble when we go home.
I'm gonna have to get the titles right.
Okay, well then I'll tell you this, and this is why I won't have a home. He's smarter than many of us with the professor title. That as he mentioned, 100 million in fees. We should also mention we had 9 points. We didn't put up the 10th point to not be too controversial, but let's put it out there. There's no correspondence between the compensation of chief financial officers and the performance of these 50 states on a 1 year, 3 year, 5 year, or 25-year basis. Not many, but have been there 25 years. But looking at what the states pay, we have actually found there's a slight inverse correlation, and over a certain time periods, I think on a 10-year basis, it's actually a significant negative correlation that the higher they're paid, the worse the state performed. There is some incentive compensation out there at several states where they're getting, basically a bonus on how they perform. Georgia pays one of the highest bonuses. They lost money last year, but some have done well with bonuses. I think is it New York has, but not that New York has done that well, but they've been paying bonuses, but some do that, but compensation hasn't been a panacea either in any remotely.
Yes, and on incentive compensation in particular, I would note that a lot of states are just now implementing that model. It's a shift that's taking place. So really the jury's still out in terms of whether or not it makes a difference. There's not enough data points.
It may prove out over time. We don't see it yet.
Okay, and my final question, this was probably better for the treasurer's office. One of the metrics presented was that Connecticut, in terms of its benchmarks, had the best performance in terms of outperformance. And I believe they set our benchmark is at 5.9%. Do you know how that would compare to the benchmarks in other states for their investment returns?
I'll jump in here. I would need to take a closer look at exactly which benchmark they're describing. As you know, they have many different benchmarks, and which benchmark we're evaluating in particular makes a very big difference. I think Professor Sonnenfeld very briefly went through some of the slides that pertain to some of the specific asset classes. And I do want to maybe come back to that real briefly because it matters in terms of when we're talking about benchmarks. Maybe on the next slide, this slide, just to focus in on this a little bit, we have a very unusual setup when it comes to private investments and our benchmarks. Private investments is its own asset class, which is different than public equities. It includes private equity, venture capital, growth funds, things in that category. There is an actual private investments benchmark that is an industry standard. Our Hamilton Lane, which is one of the leading advisory firms, is actually one of Connecticut's own external consultants. Ironically, in that 600-page info packet, they actually do benchmark our performance against their benchmark. And you can see that our performance simply underperforms that benchmark. Now, that's not the benchmark that Connecticut officially employs. Connecticut used to employ the S&P 500 plus 500 basis points, which is 5%. However, in 2020, we changed that benchmark to the Russell 3000 plus 2.5%, which of course lowers the benchmark. Now, when you lower the benchmark, it's easier to say that you're either meeting or outperforming the benchmark. So this goes to show that which specific benchmark we're talking about matters a lot. So we would need to see more details in terms of which.
Connecticut is in rarefied air in its fluidity in changing the goalposts on these benchmarks, and that's just been a problem. The same pool of money gets held up against different benchmarks, and that is certainly confusing at a minimum.
All right, thank you. Thank you for your answers. Thank you, Madam Chair.
Thank you, Representative Cheeseman. Senator Fazio.
Thank you, Madam Chair. I want to thank Professor Sonnenfeld and Mr. Tian for their hard work, and you're really doing a public service here. And it's perhaps the legislature's fault, again, over many decades, that we've designed a system that hasn't provided for that oversight. And it was required of private citizens here in Connecticut to actually do so, and we wouldn't be having this conversation, which I think is very informative to many of us on this committee. I certainly did not know this before your reporting, and it's because of your initiative. So I first want to thank you, for your work. I guess, so just to clarify, I'm pretty concerned that our internal benchmarks and your external benchmarks are so different for Connecticut's performance. First, comparing like for like, that we're eighth from the bottom over 10 years compared to say top 40th percentile against 86 or 70 different public investment bodies. I wanted to go into, you said that there's changing goalposts on the benchmarks. Are you saying that, the MSCI and the US Bloomberg bond index, that those aren't the same benchmarks being used by our pension funds year after year?
Senator Fazio, thank you for the question. And obviously, given your financial expertise, this is worth explaining the point that you're making here. During the treasurer's presentation preceding us, we had heard how he was comparing Connecticut's performance against a 60-40 benchmark. Now, how did he define the 60-40 benchmark? He gave a very eloquent explanation for why Connecticut should be using a global benchmark, considering Connecticut is investing in global funds. But then, of course, as the chief investment officer, Mr. Wright, proceeded to explain, we're actually benchmarking against the US bond index, not the global bond index. Now, with that being said, of course, he makes the point correctly that Connecticut has been over-levered and overweight towards, in particular, emerging market equities, underweight US equities, which in simple language means that the US stock market has done very well over the past decade, and Connecticut missed the bull run in US stocks. We just basically totally missed it. But the chief investment officer makes the point that when we select benchmarks, we should be using benchmarks that actually accurately capture what our portfolio is. Well, that point is well taken, but it also does not capture the opportunity cost had different decisions been made. Now, with most states, they did not have an underweight towards US stocks over the past decade and an overweight on emerging market equities. As a result, they had a much more balanced allocation. A lot of them used the S&P 500 as their benchmark. And we can see here on this slide, if we accept using the S&P 500 as a benchmark, in addition to the same Bloomberg US Corporate Bond Index that the Treasurer and Chief Investment Officer Wright used, we can see here that Connecticut dramatically underperforms a 60-40 portfolio across basically every time period, and that this amounts to many billions of dollars. It's on slide 34 for the members following along on their own computers. But this is why benchmarks matter, and this is why on the matter of comparing our performance against a 60-40 portfolio, the treasurer's point is well, and the chief investment officer's point is well taken, that because we were underweight US equities, the S&P 500 wasn't their index of choice. But had we had a more normalized asset allocation, Connecticut would have had many billions of dollars more, simply put.
Simply,
Yeah.
could have sliced income taxes considerably. Some suggest many almost as by half.
Yeah, no, I just did the simple math on 1.4 million workers in Connecticut, or 1.4 million households in Connecticut, and 6.75 billion over 5 years equates to $4,800 in lower taxes over those 5 years for the average household in Connecticut. That certainly would have been nice. My last question is, that there are 2 states, I understand from your report, that have a sole fiduciary in the elected treasurer over tens of billions of dollars of funds, North Carolina and Connecticut. And by your calculation, both are in the bottom 10 for performance over the last 10 years. Between oversight, annual independent audits and reporting and colloquy with the General Assembly, and shared fiduciary responsibility, do you think in the long run, irrespective of personnel, again, in the future, we might not be as fortunate to have, someone like Treasurer Russell as our treasurer. Do you think in the long run that these reforms in particular at a high level will generate significantly better returns so we can be able to reduce taxes by thousands of dollars per person so we can fund vital social services?
It would be all 9 of those recommendations. I don't want to speak. If you disagree with me, feel free to, Stephen. But as I think Treasurer Russell and Mr. Wright would say, Jeff, the third and fourth worst performers did have a statutory independent voice as a independent investment advisory council that had fiduciary responsibility, and they still were at the bottom of the list, not the very bottom. So that would be the defense. So it's not that wouldn't do it alone. But yes, Senator, I think all those recommendations together would have been a surefire success, and we wouldn't have had the income tax weight we have and a lot of the financial and quality of life challenges that this state needlessly has suffered.
Thank you both for the work you've been doing, and thank you, Madam Chair, for the time.
Thank you, Senator. Next, Senator Cohen, followed by Representative Farrar.
Thank you so much, Madam Chair, and thank you, Professor Sonnenfeld and Mr. Tian. You did a lot of work here, and appreciate all of it, and that of all of the students' input as well. Doesn't seem like anybody got too much sleep last night, but I certainly appreciated having these slides in advance of today's presentation and informational hearing. It sounds like from the presentation, there's some relatively simple changes to make to improve performance, like reducing redundant fees, and some components of transparency perhaps are easier done than some other of the recommendations. Some are obviously much more complex. But my question is, how does divestiture come into play? What are the impacts of that? We're seeing more of this, obviously. We're hearing more from our constituents demanding more of this, whether it be on warfare issues, environmental concerns, social implications, et cetera. How are states really balancing the needs to make sound and savvy investment decisions with high yields while addressing the concerns of constituents, as we are in elected positions like the office of the state treasurer, or even feeling as though our investments in the state of Connecticut are in line with our goals in terms of responsible investing? How do we sort of measure up there?
A fascinating question. I must admit, as you folks have all heroically allowed us to stay with you for 4 hours, it would be inconceivable if we had such a discussion about endowment management on my campus or any campus in the country if Senator Cohen, your question wasn't the first or second question, and that it's come up now at the end. That is in terms of taking a look at political, social, and environmental issues guiding where we invest, and you get in that dispute as to whether or not you want to have a seat at the table. The theory of constructive engagement, of which there's plenty of counter against, but trying to influence board actions. The state has often had a very large voice in critical governance decisions in the corporate sector. I think that Treasurer Napier and ironically, the various treasurers of North Carolina were at the vanguard of challenging corporate cronyism in decades past, and they were a great inspiration. I wish they had done a better job on their home front, but they were a great inspiration on that front, on asking critical governance questions in their investments. But in our research, it hasn't come up. Stephen, is there anything that's come up that we should?
Yes, Senator Cohen, we were not directly focused on this very important topic. I will say that across our research, we did come across many states which do have guidelines around ethical investing. Several states have a codified set of principles as it pertains to ethical investments, and other states have forms of advisory boards or panels having to do with that. And in addition, Treasurer Russell, I think in his own comments, alluded to some of the efforts that Connecticut is making as well.
But we would add that in the research we've seen so far, that those companies that did have states that did have such screens did not hurt their constituents, that doing good was not antithetical to doing well. You know, we're not advancing today any particular political investing decisions, but it didn't hurt them to practice their whatever they thought is a responsible investing pattern. We're not aware that it was in any way disadvantageous to the public if they had such screens. I think sometimes they made unwise decisions. There are some funds would routinely screen away from defense industry, for example, and not to be advertising for our friends at Pratt & Whitney and Sikorsky and others, but there are a lot of aerospace funds, defense funds like Raytheon, which is a purely defensive company. The country, I think many Quakers in the country would celebrate the Patriot missile system. It's a defensive system, and Raytheon has been a leader, now RTX, but has been a leader in the foreign corrupt practices. That had a lot to do with the development of it, going up against their industry peers, and sometimes it's dangerous to have a whole category of investment decisions guided by avoiding a sector or an industry, and that's true on the energy front and defense fund and others. And I think most Connecticut companies, we're very proud of who they are to the extent to which we're invested in Connecticut companies.
Yeah, well, I really appreciate both of your comments, and I'm interested in this topic, so would be interested to learn more. Obviously, divestments have a full spectrum, a full political spectrum, and certainly impact the performance of these funds long term, certainly. So it would be interesting to take a look at. I think that we've made some divestment decisions in the state of Connecticut. I certainly think some of that has to do with our own goals, as I mentioned. Some of it has to do with political pressure, outside pressure politically, and some of it has to do with obviously needing to ensure that these funds are providing the returns necessary after years and years of mismanagement. So I'm happy to see that we're making some progress, and also, like I said, very happy to see some of your recommendations here today. Appreciate all your hard work and your answers to my questions. Thanks so much.
Well, thank you, Senator. We just mentioned as an aside, we have shown in scholarly publications that of the roughly 1,200 firms that pulled out of Russia, for example, over issues of politics and global principles and human rights, is that it was advantageous to the companies who pulled out, that the financial markets, for the most part, celebrated those moves and didn't punish them. So thank you for that question.
Wonderful. I know Connecticut was one of those that did that. So thank you.
Thank you, Senator. Representative Farrar, followed by Senator Wong.
Thank you, Madam Chair. Hi to you both. Thanks for being with us. I did just want to go back to your list of recommendations for next steps, because I know there's been some pieces that were mentioned in reference to other states and some suggested statutes. I don't understanding, I don't necessarily expect you all to go through one by one, but I think it would be helpful for the committee to know within each of these if there are particular statute recommendations, and if those are kind of correlated with what is happening in other states. I know we heard about number 6 in reference to North Carolina, but if you're willing to follow up with us as a committee and share, within each of these recommendations, if there are particular statutory recommendations within them and how that compares to other states, I think that would be wonderfully helpful.
Madam Vice Chair, I'll jump in and say yes.
Thank you.
Absolutely.
Okay.
I'd be happy to.
Yes.
Thank you.
We hear discussions among different legislators that have proposals. We like everything we've heard so far. But we'd love to help any way we can, but we're not lobbying to be crowding your schedules again. And we promised not to charge a penny more than what we already charged, which was $0. If anything we say can be of value, but we also won't be offended if you never want to see us again, but we'd love to help.
Yes, yeah. As you can understand, we're trying to kind of sift through what we might do from a legislative body versus, as you know, might be something that the Treasurer's Office pursues more from a policy standpoint, and just kind of understanding your all's thoughts on that and what other states are doing. We would welcome that feedback. So
that would be great.
Anything else you could provide in that arena on these recommendations would be very helpful.
Legislative proposals about independent audits reviews being reported into the legislature, perhaps the comptroller, the strengthening of the advisory council, and the continued elimination of poor performing by statute, poor performing asset managers, I think would be fantastic.
Thank you for that. Yeah, thanks for any follow-up information and thank you to the chair.
Madam Vice Chair, just to respond, one last point there. You'll
Yeah.
find across several of the different recommendations, there's different levels of standardization
Right.
across the different states. There are some recommendations where there's much more cohesiveness across states. For example, not just with the sole fiduciary issue, but obviously with legislative oversight as well. You'll find that many states have some ingrained system of legislative oversight. There are other specific recommendations, for example, the pruning of underperforming managers, where there, even though that is there as a best practice, the specific form it takes. I think it was Chair Horn's language that, that there's never just a single right answer sometimes. And that's exactly what you'll see in some of the comparative state statutes for some of those specific recommendations.
Thank you. Thank you both. And thank you to the chair.
Thank you, Madam Vice Chair. I was just going to note that your hours of uncompensated labor are being rewarded with requests for more uncompensated labor. So
So glad
thank
you
you.
came. Yeah.
We should probably, I don't want to offend the Current and the Mirror and everybody else here, but Hearst was really nice at putting the names of all 18 students out just in time for their parents' graduation to see how they were spending their time and what their wild parties. They actually put it in the newspaper on a full page, and it was remarkable. So we want to thank Hearst newspapers for doing that.
thank you. Senator Wong.
Thank you, Madam Chair. Compliments. I just want to echo the compliments and the gratitude from many of our colleagues to you, Professor Sonnenfeld and Mr. Tian. And I think one of the biggest compliments we give you today is the fact that you have taken a very sophisticated and complicated financial analysis and you simplified it. You simplified it for us in the legislative body to really understand in simple, basic, elemental math. Our performance in the past years have been beyond poor. And I appreciate the analysis that in listening to Steve, he just flows of information that's kind of beyond remarkable. But I wanted to get your perspective. You've cited some recommendations for next steps, and you're speaking to the legislative body here. The two areas that I see in regards to where we can be of assistance, if we have the courage to do so, is recommendation number 4, to establish clear and reasonable criteria for replacing and underperforming investment managers. In industry, that is clear as day. But for us, we have no clear barometer. What would your recommendation in regards to implementing that? That's question number 1. The second area is another controversial one is recommendation number 9, to establish a statutory eligibility requirement for future Treasury candidates. We did that for Attorney General. What would you say for us to be able to have the courage to do that in the political environment?
You know, as you know, there are some states where you don't actually have to go to law school to be an attorney. You can take the bar exam. There are 3 or 4 states still. In Connecticut, I think it's fantastic for Senator Huang for it's coming out with guidelines for attorney general. We are in plenty of good company of other states that don't have eligibility criteria. Our fantastic treasurer would handily transcend, I think, any criteria we would come up with both in professional skills, disposition, expertise, and all the rest. So we certainly wouldn't lose the treasurer by throwing that criteria out there. Treasurer Rush will be fantastic. But I think we could certainly be on the vanguard of doing a great job on that front. So I'm glad you mentioned that. We put it at the end because we don't want to say that we're behind the pack on that one. But Senator Hong, that's a really good one. And also, if you don't mind me complimenting you for addressing your question to the brains of the gang, you're right. He is the one. You don't really need me in the future on any projects. I'm there to help add color to it, but he's the one who does the really brilliant analysis with the students.
And let me be clear. I want to applaud our current treasurer, Treasurer Russell, who has done a spectacular job. And evident by the successful returns, but we can get better.
Yeah,
we can get better. And maybe if I can ask Steve to answer in regards to recommendation 4 and explain that in industry, you're always benchmarking and measuring performance. We don't have any such criteria in the state of Connecticut in our investments. Would that be correct?
That's for the most part correct, Senator Juan. That's right. I would note as a couple of caveats to that. First off, you can see here that many of the underperforming funds were entered into historically. They weren't entered into particularly recently. So it seems that from an allocation perspective, we have somewhat improved, but we do have the overhang of many of these underperforming funds. Now, of course, exiting some of these funds sometimes can be challenging. So depending on the fund, there is that caveat. Now, on the next slide, real quickly, just
There were few hindrances on exiting than many people would presume, though there weren't a lot of penalties to clear the hand. And that's something I think that could be widely misunderstood, because a lot of times there are exit penalties, but in many of these cases there are not. But yeah.
That's right. And then just one extra level of nuance on this topic. It is important to not just look at the overall result of the fund, but also to compare it within funds from the same quote unquote vintage year, which really is just the year that the fund was launched. Obviously, funds launched at different points in the market cycle will have differential results. And that just makes sense given the ebbs and flows of the market. And we, even when we do benchmark within funds from the same vintage year, there are still a lot of underperforming Connecticut funds that are in the bottom quartile of performers from that vintage year. And those are really the underperforming funds that Senator Juan, you're correctly focused on. Those are some of the funds that frankly are problematic.
And I think it goes back and ties to recommendation number 9 is the fact you need to have a treasurer with a skill set to be able to kind of extrapolate these kind of differentials and really understand the performance measures like the both of you have articulated so well. And I'll end by simply asking, I think it's important to just simplify. Why does this matter so much? Because the bottom line is this could save taxpayer burden. It would create a larger distribution and reliability and stability in regards to our pensions. This matters because it ends up impacting residents and taxpayers in the state of Connecticut, and it is imperative for us to do this. So I want to thank the chair for articulating and inviting you to be able to share this insight. It's been incredibly informative. So thank you for your time. Thank you.
Thank
Mr.
you,
Chair,
Senator. If I
Madam
could
Chair.
just add to your close there, but I should ask permission probably for that. I just wanted to say that you're right to the list of the burdens. Earlier in our discussion, we talked about the 2% burden on the wages of state employees too, which is frankly a regressive tax of sort, as you can see here, just because even transferring the $8 billion of share of taxpayer revenue, that still isn't enough to make it whole to pay down our pension burdens. We still have every year take money back from our own employees, which just doesn't seem fair.
To read one line from this memo to all employees, when the fund's investments fail to perform as expected, the state must make a larger contribution to cover the anticipated costs. Thus, the fund has underperformed. Thus, therefore, beginning with the pay period, members of the Tier 4 retirement plan will be required to contribute an additional 2% of their gross earnings. So these are very real costs that are borne by the teachers and by the public employees of the state. And these percents might seem like small numbers when things are off by 1 or 2%, but every 1% is $550 million. Every 2% is over $1 billion. That compounds over time. So even though these decimal points and percentage points might seem small, they translate into very big numbers, a very big impact.
Thank you, Senator. I'm going to recognize myself for the second time, hopefully ask a couple of quick questions. I want to pick up a little bit on something Senator Wong just said, which just basically emphasizing simplicity. And that I mean, there's so much to digest in your materials, but a lot of them are, we are not investment professionals. We will never be. We have legislative oversight here, but in order for us to do that job, we have to be able to see with clarity what is happening. And so partly this is probably a repeat of what Representative Cheeseman asked you about, in your overview of other states, if there are good models that you have seen in terms of clarity with respect to legislative oversight, we would very much benefit from seeing those models, because that is to me, we are never going to be in the position of saying, second guessing investments, but we have to look at that benchmark and with some level of understanding. And I know there's always arguments, you lose lots of nuance, but we have to be able to have some long, thread comparison. So again, anything that you have there, we would very much.
Something which that has brought to mind, because we're right now thinking, should we give endorsements of states right now or come back at you with a more thoughtful list? It also occurred to me something that we didn't put in our presentation today, which we stressed when we reported it last year. And that is, given that those physically in the room representing the legislature are still perfectly balanced, I think, between half blue and half red, is that there was no red-blue contrast in terms of the state. North Carolina was just as bad as we were, and they were obviously, depending what happens there from day to day, are still largely a red state with the blue governor. But then you have places like Massachusetts. I mean, it's right across the board. The top performers. It's astounding. It had nothing to do, as we could see, in terms of national politics or ideologies. It had to do with competence, like Senator Huang was asking, and who's there, and diligence.
And on simplicity, I would just note on this point in particular, we'll come back to you on different models of legislative oversight. That's obviously a very important topic, and we'll prepare much more comprehensive materials. But on the point of simplicity, this is a space where there's a lot of jargon. This is a space where there's a lot of techno speak, but a lot of it is not as complicated as it might appear at first glance. Ultimately, what this comes down to is how can you generate the most return on investment on the capital that's contributed by state employees for their own retirement. And there's obviously a lot of choices. It's more of an art than a science along the way. But at the same time, there are choices where there are defined best practices. There are choices where we can see, perhaps historically, Connecticut has veered away from those best practices. And if you boil things down to the essence of what's really driving that underperformance, you can see those key factors there if you strip away all the jargon and all the techno speak and really just focus on what those key drivers are. And that's what we've tried to do, very much so.
And that's so true and well said. I mean, we make complicated medical decisions and information technology decisions every week. We don't often understand, though, the technical details, and how some of these systems work behind the surface, but we get enough to make an intelligent decision. We should be able to do it in this space as well, without getting layered in the jargon.
Sure. Go ahead. I'd just like to file, thank you, with respect to an excellent question, Chair Horn. But Professor Sonnenfeld, you said competence. We can't legislate competence. These are offices that are elected, and that process, as you know, is as varied and unpredictable, even though many may think it's not. But I think the issue is, how do we, Washington State, I don't know if it's perennially in one of the top performers, but they are right now, at least according to your report. Is there any magic there, or is that because their treasurer is particularly well?
There's a causal effect. We talked about things that are good to have, which was, I used the term diligence and competence. But the diligence drives the competence. That's the essence of good governance. We can take a look at some companies in the headlines today that should have done a better job in their board governance and getting the competence. We can take a look at this poor performing asset management issue and see if a diligent oversight would have forced competence in who the asset managers are, just like we would have had safer airplanes at Boeing right now had the board done certain things that they should have been doing over the years. There, again, as I mentioned, that company, there are no villains there, but there were a lack of diligence led to competence problems.
Yes, and I would note on page, I believe it's, looks like it's page 39 of the old slide deck, not this slide deck, but the slide deck from last year. Not this one, but
I can't find it.
You can't find it, but the members of the committee have it. I think it was distributed to them. We do break down actually the asset allocations by all 50 states. It's in that presentation from last year. For Washington State in particular, I do believe that the primary differentiating factor of Washington State is that they had more leverage, they had more assets allocated towards so-called risk assets, which really are just public equities and private investments. So it looks like they were much more underweight on some of the fixed income, so bonds. They didn't have many bonds, and they had a lot of stocks, and they had a lot of private equity in simple terms. So it was really a factor of their asset allocation being very heavy on the risk assets.
You said that to me, I can reject it.
Yes, well, all right, you know what, I could probably put that too, but we'll figure it out.
Okay,
We'll figure it out.
It's a
Okay, I'll
beautiful
leave it,
chart.
I'll leave it to you to figure that out.
But page 39 of last
Okay.
year's slide.
And then my last question has to do with, the use of index funds, for example. So I can say that I have personally spent a lot of time taking some local nonprofits and community investment funds and encouraging them to fire their managers and to index their funds and save themselves, significant fees that can be spent on their mission, to your point. Take that, those smaller examples, run the gamut to, Yale's investment fund, which is a market maker, is basically its own sort of financial business because of the, and the returns it's able to generate by virtue of being, a mover and shaker, a mover of markets. And where would you, on that continuum, where would you put Connecticut in terms of its pension funds, in terms of how much we ought to be in, indexed low, no fee investments versus where we ought to be and where it is worth paying fees for, those who truly can beat the market?
It comes down to by asset class, and there are certain asset classes, as you pointed out, public equities in particular, as well as fixed income, where, as you pointed out from your own experience, you know very well that most active managers do not overperform the market in those asset classes. Empirical studies show it's basically a wash. And then if you factor in fees, active managers underperform the market since they're taking so much in fees. So it's a zero-sum game there. And as you pointed out from your own experience, when that is the proven track record, there's no reason for us to continue allocating towards active managers in those asset classes, where we'd be getting superior performance, as we show from that 60-40 portfolio, relative to what the active managers have been delivering, and we can save on fees while we're at it. Now, there are certain asset classes, especially on the private investment side, whether it's real estate, private equity, private credit, where there are no index fund equivalents, if you will, and where manager selection really does play a bigger role in terms of the quality of the manager. And that's where, as recommendation number 4 comes in, manager selection makes so much difference. Yale has always, been religious about pruning underperforming managers and allocating towards overperforming managers. Historically, perhaps not now, but historically, Connecticut tended to have the habit of doubling down on a bad bet. And in manager selection, that is a very bad thing. If you have a historically underperforming manager in private investments and you continue allocating towards that same underperforming manager, hoping for different results, it's unfortunately that's a problem. So obviously for the asset classes where passive makes sense, hopefully that transition will continue and more assets will migrate towards passive. That'll save us a lot in fees. That'll probably boost our performance, at least from what empirical studies show. And for the assets where there are no index fund equivalents, hopefully manager selection and pruning of underperforming managers, and a focus on selecting top performing managers will continue to continue to have some impact on boosting Connecticut's
Roughly
performance.
18 months ago, a huge amount of money was, for example, put in a consistently poor performing manager. And that's sort of that doubling down. It was it literally was almost doubling what we had put in that consistently poor performing manager. I think, well, why are we doing that? But I think in terms of private equities, in terms of the actual equity bond mix of investments, that the average household in the country is about 70-30 mix, and that way outperforms us, historically. Just any average US household has outperformed us by doing a 70 equities, 30% bond mix.
That's the irony in all of this. All of the state employees and all of the teachers whose funds are professionally invested in the pension funds, they'd be doing much better probably if they were just investing on their own, as most folks in their own retirement accounts know. It's really just a generic 60-40, 70-30 blend of assets that most normal American citizens have in their retirement accounts. And again, if you're taking, again, you can take different variations of the 60-40 and different benchmarks, but if you're taking a US 60-40 portfolio, that dramatically outperforms what Connecticut has received. So it's ironic that perhaps our public employees and teachers would have done better on their own.
Without all these
Historically.
expenses and losses and everything, they just put it there. They would have done better on their own the way their neighbors did.
Seeing no further questions, again, I thank you for all the work that you've put into this and for your dedication of a good half of this day to us today to help explain it. So my thanks.
Thank you. We're honored by your interest and your attention.
We are adjourned, I suppose, but actually before I adjourn, the next date, Madam Clerk, is our, what's next?
Tomorrow we have another info forum on the Brainerd Airport property study at 2:30.
Very good. Thank you. See y'all then.